workers. Let's talk about the plants that are protected. TK, the Ford F-150, the Chevy Silverado, Ram pickups. If they want to ramp this up and escalate things, there's space to do that.
Well, they can do it, but they got to spread out the strike payments. And I'm sorry, I hope we have this here. I was going to use it with Craig. Let's use it now. The Bronco, Colorado Wrangler strike. Now, my up to speed, Matt Miller's our expert here on is a Colorado cool, the GM Colorado pickup truck. I have no clue.
The Bronco's pretty cool.
The Bronco's big time cool. Like we had the CFO on sitting right here, 6 weeks ago, and he said basically they can't make them fast enough.
Well, now they're not making them at all, Tom.
Yeah.
Based on these strikes. From New York, if you are just tuning in, let's get you some price action. Equity futures on the S&P 500, positive by 0.1%. In the bond market, the data in America, pretty decent. Yields higher again this morning by 3 basis points, 432 on a 10-year. At the epicenter of everything we discussed yesterday, Tom, retail sales, PPI, the ECB, the downgrades to the outlook of the airlines, this right here, $90 crude in America. Tom, WTI, positive here by a third of 1%.
You got $94.63 intraday Brent crude. Javier Blas has beaten me over the head about Saudi Light extrapolating out to $100 a barrel. I'm sorry, it's moving fast, and you're dead on. It colors every conversation, including Bloom out as GM of the Red Sox.
It colored the ECB conversation too. We'll talk about that later, Tom.
Yeah.
The euro looks like this.
The Red Sox.
106 on euro dollar. Currently 106.64, and Bramo potentially heading towards a 9th week of weakness against the US dollar.
The longest potential streak of weakness since the joint currency was created, just raising the specter of whether these higher oil prices are a good thing on the heels of better Chinese data or a bad thing in terms of disinflationary and stagflationary kinds of ideas. Today, 8:30 a.m., September Empire manufacturing data, followed by 9:15 a.m. industrial production. Messy. It's getting really messy. But if we start to see a plateauing, does it really mean anything, especially after you do see input prices increase and on the heels of the strike? It's just a messy moment. 10 a.m. adding to the mess, the University of Michigan Consumer Sentiment Survey, which both of you love and really hinge on and really try to determine the sentiment going forward. Honestly, how much does this really reflect what we're seeing with respect to higher oil prices?
The rate of change of oil prices.
Exactly.
I mean, John, I was doing that math yesterday, and the blur, I can't remember the numbers from July or June. And come on, we're on the edge of moonshot.
It's always amazing how spot crude prices and where gas is right now can shape perceptions of where inflation will be later, and no doubt we might get a sense of that a little bit later.
And how much people are willing to spend. And at 10 o'clock, we do hear from the France Economy Minister, Bruno Le Maire, with Bloomberg's Maria Tadeo. But this comes as EU financial ministers meet in Spain. Christine Lagarde will be there, the EU Economy Commissioner Gentiloni, Spain Economy Minister Nadia Calvino. This is going to be awkward because they really disagree. You heard from the German finance minister. This is a good thing.
What's the outcome of this meeting, Bramo?
Well, they're going to be talking about what the region needs and what the specific countries need to foster some growth at a time of really stagflationary headwinds and a controversial rate hike yesterday among some of those officials. And so we've already heard that pushback.
Calvino already complained on Bloomberg TV the last 20
She was
minutes.
with us. I loved it. I loved when she was here. I mean, they're really living between climate change and inflation of the agricultural complex known as Spain. Spain is getting hammered.
Big time.
Yeah.
Europe, many parts of Europe, including Germany for that matter, getting hammered
too.
too.
Okay there?
That was wonderful. That's enough ECB chat. Let's get back to our top story. Strikes at the big three in Detroit. Craig Trudell joined us out of London. Craig, we've got them, all three, simultaneously at the same time. Craig, at what point did this break down? How big is the difference between GM, Stellantis, Ford, and UAW?
I think the writing, honestly, seems to have been on the wall. I think we've for weeks now known that the union and these three companies are far apart. In terms of the negotiations, I think on both sides you have complaining and sort of allegations that neither side is budging or going anywhere close to sort of the other's direction. So I wouldn't necessarily cast this as a breakdown, a sudden realization that what, we're just not going to be able to do this, because we haven't come anywhere close to these companies in this union being able to come to agreements on new contracts.
Auto Guy, what is this? What is the imagery here or the message from Bronco Colorado Wrangler. I mean, those are all cool cars for 23-year-olds, right? Is that the message?
Yeah, I think it's both. These are cool cars. These are profitable cars. These are trucks and SUVs that these companies count on for serious revenue and profit. That being said, the UAW does have some very big, sort of arrows in its quiver to sort of, use some imagery here. They do have the F-150 pickups, the Silverados, the Rams, as mentioned earlier, and just generally they have quite a few plants to add to these three facilities that they're walking out from. It's really interesting to see the companies, not know sort of what's next. The union is explicitly talking about sort of keeping these companies on their toes. And also, I think, the union is being strategic about, striking every one of these companies, but also doing it in the selective fashion means that they could draw this out and not deplete their strike fund, too quickly.
An index that the government uses is the Welch-Trudell We Run Out of Money Index. Craig Trudell, when does the union run out of strike funds?
That, of course, will depend on, just how much additional pressure they want to exert on these companies.
Give me a date. Christmas?
I mean, what we saw with GM, right, is months long a few years back. And so, I do think that this is absolutely the case that the union could drag this out for weeks, potentially months. Now, whether we see, the union be able to reach an agreement with one of the companies and go back to, pattern bargaining like we've been used to it in the past, I think, the unfortunate answer is we have no idea what the union strategy is, and that is very much their intent at this point.
Craig, do you get a sense of what the line in the sand is at this point, of what will get it done?
I honestly don't have any clue of sort of what could possibly get us to a point where either side is talking about what we feel like we're closer. And the problem here is that there is so much going into these negotiations. We don't just have a simple issue of one side wanting a certain amount per hour and another side wanting a higher or lower wage than that. We're talking about cost of living adjustments. We're talking about representation of battery factory workers or whether or not those stay non-union. We're talking about pensions. And so there is so much that's going into these negotiations. They're so complex and multifaceted that it's really difficult to sort of, game out what is it that's going to sort of, get the union comfortable with what these companies are willing to offer.
Craig, stay close. We've got a lot to talk about. Craig Trudell there out of London on the latest. TK, where is the most pro-union president in the history of this country?
He's got to get up and he's got to get his Wheaties here this morning. But can you imagine the conversations of how to explain to this is not the strike that young Joe Biden knew, or frankly, young Tom Keene knew.
He has to come out on their side, doesn't he? New. You can't sit on the fence here.
That's a really important question. Very importantly, Anne Marie Horton and Joe Matthew have the former vice president of Indiana tonight. You wonder does Mike Pence stay on the fence? I mean, does he talk to the UAW in Indianapolis here? I don't know if they're not in strike yet, but maybe they will be.
Sure.
Do these guys stay on the fence given a strike? That's
the former president. I think everyone's after the vote of this particular union. Yeah. Euron Timmer joins us now, Global Macro Director at Fidelity Investments. Euron, we're going to have some time together to talk about markets. Just wanted to get your thoughts on this strike. And a question we've asked continuously over the last couple of weeks, whether you view this as almost the dying embers of a hot labour market, or whether this is something we're going to see more of in years to come.
Well, good morning. And that, of course, is the big question. Has the labor versus capital pendulum swung for real? And I think there's some good reasons to think that maybe it has, because the last couple of decades, favored capital holders, right? Period of low inflation, low interest rates, of labor arbitrage around the world. Perhaps that trend is ending. And I think what we're seeing in the headlines today speaks to, the issue of whether inflation really has become a structural phenomenon or whether it was really just a passing thing that happened during COVID. And so if we're going to head to an inflation era of, let's say, 4% instead of 2%, then all the assumptions we make in the markets, and investing, as you know, is making real-time decisions with imperfect information. All those assumptions need to be questioned, including when the Fed will pivot, if it will pivot at all, whether it's even done tightening, whether the TIPS market is correct in pricing in 2.25% inflation as far as the eye can see, what that does to the term premium, and if the term premium, which is still negative, flips to positive, we could be at a 5 handle in the 10-year. So there's all kinds of snowball effects of whether we really are in a new inflation era.
You're into John's good question. The heart of the matter to me is a $63,000 GM Colorado Bison pickup. It's not what you and I lived was if the rich kids had a $9,000 57 Chevy. This is about the partition in America of the haves and the have-nots. They're building cars for what? 15% of America?
Yeah, I mean, it speaks to perhaps the end of this very, very long period of, what we call the Great Moderation. And obviously the wealth equality or inequality is part of that same mechanism. And a lot of very smart people have written, a lot of very good reports about that. But if that trend of great moderation really is reversing, then that really changes a lot of the assumptions we make as investors. And so, including the valuation level in the S&P 500, maybe we're heading into not a bear market, but a period of valuation headwinds instead of tailwind.
True. Jurien, you're going to stick with us. Fantastic to have you with us. Jurien Timmer there at Fidelity Investments. TK, is this another story that just screams high for longer?
Well, higher for longer. It's going to disrupt everything, and it comes back, as Lisa was mentioning, on growth in Europe. I'm sorry. All of the babble we do about rates and that comes back to economic growth. And
every single time.
There was a headline yesterday that Lagarde wanted to ignore. And it's the same thing here. What does this strike do to our U.S. GDP?
Sarah Hunt of Alpine Saxon Woods in the next hour. Jurien Timmer sticking with us, and we've got to squeeze in a little bit of a conversation about a man who was stuck at Burning Man for 2 weeks. Jurien Timmer was that man. Equity futures on the S&P positive here.
Should I go to Burning Man?
Good morning. No.
Still a very tight labor market. You're not creating jobs at the pace that you were. But there's absolutely no sign of that switch being flipped and for workers to start being laid off. So, I think power is still in the hand of a worker rather than the manager. I'm not worried about an organic slowdown in the U.S. economy. There's no sign of demand falling off a cliff.
Power in the hands of the worker. Michael Schauer, CEO of Market Field Asset Management. Fantastic to catch up with him. We have strikes on the big three, limited strikes, and I think that's captured in the stock price this morning. Ford is down by 1.7%, GM is down by 1.5%, Stellantis is actually positive.
It's
so far
un-American.
This morning.
Come on, it's Chrysler.
TK, 12,700 workers across 3 plants. For now, it's limited. This is about how long it goes on for and whether it spreads.
Now we're going to learn about this. I mean, limited till when? Friday? Next week?
Don't know.
We don't know. We're making it up as we go. The way I feel sensitive about this, John, and I mean, I guess we got to do data here, but, I believe in community, art, self-expression.
Where are you taking this?
I just, the mail's coming in. Someone named Anne Marie in Washington emails in and goes, "What would you wear at Burning Man?"
At Burning Man. Okay.
I wear what I wear. I wear this everywhere. So I took 3.
You wear a bow tie.
I took 3 suitcases once to Asia. Never again. This is the uniform.
Just a bow tie or other clothes around?
Oh no, I'd wear this. There'd I'd
just trying to figure this out. Bramo, just trying to figure it out. Just want to know.
What's the appropriate, Lisa? What's the appropriate mud boot? There's got to be like a Farmall Great All mud boot or whatever.
You think that I've been to Burning Man? I don't know. And normally you wouldn't need a mud boot.
You say Burning Man. I can see Bramo there.
Bramo at Burning Man?
Would you like
I can now see you at Burning Man.
Actually, you'd be your own arts installation.
I think that would be very cool.
Community art.
You just welcome and everyone would gather around the campfire and Tom would tell you stories.
Yeah.
Perfect. You can talk to Jurien about
Bring
it.
in Jurien here.
Jurien Timmer, do you think Tom would fit in at Burning Man? Does that work for you?
He knows how to cook. He fits into our camp any day.
Do you know how to cook, TK?
No. I know how to boil water.
Jurien, sit tight. I've got to whip through some price action just briefly. In the equity market on the S&P 500, we're shaping up as follows on the S&P futures, just about positive by 0.1%. I want to look at the euro. Positive here by 0.2% to 106.66. For the euro right now, what a tough position. The ECB didn't want to commit to a pause, but it certainly sounded like a pause. The complaints that they're getting so far this morning. We already talked about the pushback from Spain to Maria Tadeo moments ago on Bloomberg TV. This from Matteo Salvini, the Italian Deputy Prime Minister, had this to say. The ECB, which doesn't care about the economic difficulties of families and businesses, is increasing the cost of money. Lagarde is living on Mars. Is the message coming out of Italy, Tom? A certain part of Italy this morning.
Oh, this is the divide of Italy, and it's like the 50 states of America. But every lesson we've learned is it is not the 50 states of America. And the fractious Europeans each have their original story. The key single word I saw yesterday, going back to Trichet, is the word transmission. These dynamics transmit through the American economic experiment way different than they do through Europe.
They transmit through the banking system in Europe in a much more profound, pronounced way. Jurien Timmersberg, Global Macro Director of Fidelity Investments. Jurien, can we get a flavour for the Federal Reserve next week from the ECB, or is the ECB just its own beast on its own planet, perhaps, as Matteo Salvini pointed out, perhaps on Mars?
I think the Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent, and the question is, when will it pivot, if ever? The market has been consistently incorrect in expecting an imminent pivot. And the market can be forgiven for that, because history shows that when the Fed stops tightening, it usually starts easing very quickly after that. So maybe the forward curve, the SOFR curve, is just a math project based on history. But the big question is the stock market has been playing the soft landing scenario, and that certainly is panning out in terms of the economy. Earnings looks like it has bottomed in the second quarter, but part of that scenario was an imminent pivot back towards a three handle. And I think the news that we're seeing about the strikes, inflation in general, core PCE remaining pretty sticky above 4%, and what we saw in the ECB is that the higher for longer narrative is going to persist, even if the Fed is indeed done tightening rates. And that is something that the market really isn't priced for.
Well, let's talk about the price of energy. $90 crude. Does that disrupt the soft landing hopes and dreams?
It could. I mean, obviously, American consumers are spending less on energy than they used to, a few decades ago, and certainly on the core inflation measures, it's going to have a limited impact. But the base effects of the inflation data from the last few years, of course, that ran out a few months ago. So we have likely seen the most of the improvement. And I think the fact that core PCE, super core PCE, all remain at a four handle, even though the TIPS market is pretty steadfast on predicting 2.25 as far as the eye can see, I think is definitely a disconnect between the market and the reality. And it's certainly one of the assumptions that I think we all need to look at, because it will reverberate to many other aspects, right? I mean, R star at 1%, you add inflation, it tells you neutral policy is maybe 3.5. Well, maybe neutral is 5 instead of 3.5, in which case the Fed isn't even that restrictive yet. So there's a lot of, there's a snowball, a chain reaction there once you start questioning the assumptions that we have in the market today.
So you're not buying, Yuri, in this idea that we've reached the end of rate hikes, both in the ECB and the Fed, like many people think?
Well, I think we may very well be at the end of rate hikes. But again, the question is, how restrictive is the Fed, right? So if you look at the TIPS market and the Fed's at 5.25 to 5.5, the Fed is at plus 300 basis points versus inflation, which is very restrictive, right? And if you look at R star 1.25%, you add 2.5% inflation, the Fed is restrictive. But again, these are all assumptions, and that's one of the challenges that we have, is that we're all making investment decisions based on assumptions about whether a certain regime will persist or whether it will reverse. And it really does all come down to inflation. And when we look around us, to me, it looks like it's going to be a lot harder to get from 4 to 2 than it did from 9 to 4.
So, Jurien, final thoughts on what we should do as investors? Park in cash, hide, take my 5% yield. Jurien, what should I do?
I think this is becoming a more tactical market, which I hate to say because I tend to not believe in tactical trading. I'm more of a long-term person. I do think, some variation of the 60-40, whether it includes cash or tips, remains a good idea. I mean, in the bond market, for instance, you're getting 4.3%. If we go to 3%, that's a 10% return. If we go from 4 to 5%, that's only like a 1% negative return. So the risk reward in the bond market, even if bond yields have not finished rising yet, remains pretty compelling in a 60-40 portfolio. So I'm still there. I'm still constructive. But when I look at all the factors that we're discussing, and I look at where we are kind of in the secular bull market, my guess is that maybe we're in the twilight phase of that secular bull, and we're going to start seeing valuation headwinds instead of tailwinds. And again, that doesn't mean the market goes down. It just means that price action has to be completely carried by earnings rather than PE expansion.
You're always thoughtful. Thank you, sir. You're Timmer there at Fidelity Investments. A ton of multiple expansion through the year so far. These yields just aren't going anywhere based on what we've seen over the last month. The 2-year still in and around 5%. The 10-year still at about 4.32. Had a lot of people lining up to say this move, Tom, was unsustainable. And here we are, another month, staring down the barrel of the same numbers on a 2-year, on a 10-year, on a 30-year.
Except there are singular statistics that agree with that, like Swiss franc, Euro Swiss, really hasn't moved, doesn't indicate fear out there. And I got a single bullet, 93.94 on Brent crude. That's moving.
That's a big change.
I don't know how that changes the debate here, other than in a slower growth environment, that helps.
It can change, of course, but Lisa, the 30-year is back in the 440s this morning.
The change has been that the U.S. economy has withstood some of these higher energy prices and seems to keep chugging along.
Let's see if that can keep happening based on what we saw yesterday in retail sales. Pretty decent, supported by what's happening with gas prices. You want to talk Formula One? I know you do. I can see it on your screen. Got to wait, Tom. Neil Shearing of Capital Economics.
They drive at
it's
night.
Coming up from New York. This is Bloomberg. Elon Musk and Tesla must be feeling good this morning. TK, the competition from them. You've got the big three trying to make this big EV transition. Union workers going on strike.
$94 a barrel.
They're in a good spot right now. Equity futures on the S&P 500 positive by 0.1%. A little bit of a lift here on the Nasdaq. A little bit of a move lower. We're down by 0.1% on the Nasdaq. Still heading towards a week of gains on both the S&P 500 and on the Nasdaq as well. Small caps had a really nice day yesterday off the back of the data in America. The Russell up again this morning, Tom, by 0.1%.
It's very cute of you to bring that up, because it was a massive short cover in small caps. And this goes to my questions of the week, folks, of what is the bet on the market? I get too many people telling me the bet is up, the bet is complacency, and I don't buy it. I think there's a lot of people out there betting the gloom. And yesterday they went, okay, there was a lot of gloom there. Dow up 300 points.
Right now, the reality is resilience. You see that in stocks, and you see it in the bond market too. Just still in and around 5% on a 2-year. 2-year right now, but another 3 basis points to 5.04%. On a 10-year, 432, up 3 basis points there. And in the 440s again on a 30-year yield, up 3 basis points, 441.43. The good stuff happening in America. The more difficult stuff happening in Europe, and that means one thing. The euro's weaker, the dollar's stronger. Euro-dollar heading towards a 9th consecutive week of dollar strength and euro weakness, 106.63. The toxic mix this morning, Lisa, you know it well. It's 94 Brent. It's a weaker euro. That's a problem for Lagarde, who's talking up a sluggish economy.
Which is the reason why she's getting a lot of pushback. So now she's got to deal with the political blowback from other finance ministers in the region. And you understand how Europe is not the U.S. when it comes to lots of different states. It is a different picture in Europe. And this, to me, is the question. Is this really about the U.S. withstanding higher oil prices in a much stronger position than what we're seeing in Europe?
Without a doubt. But could you imagine how much worse it would be if we didn't have almost record output in America, Tom, for crude?
Well, this is our non-energy
close to 13
policy.
million barrels a day in America.
It's not said enough. I mean, there's the whole political thing, and maybe Anne-Marie and Joe will talk to Vice President Pence about this tonight, about the Strategic Petroleum Reserve and all that. But yeah, you're right. There's been a successful energy policy in America. Shock based on technology.
Despite this government or because of this government?
Come on,
Maybe.
Don't. That's a question for Bramo, not me.
Maybe despite. We'll catch up with Anne-Marie a little bit later this morning. Under surveillance this morning, the United Auto Workers striking at each of Detroit's big three car makers after the deadline for a new labor deal passed overnight. The strike hitting plants in Michigan, Missouri, Ohio, with the UAW looking to cut production of profitable vehicles while minimizing the impact on their strike fund. Lisa, we've talked a lot about the logistics involved here, the strategy involved here on behalf of UAW to keep this a surprise and ultimately also to make sure they've got something in their back pocket if they want to escalate things.
At the same time, you have to wonder whether this prolongs things or whether this is basically pushing out the deadline in a bit. You know, in other words, if you weaken the ramifications of the strike at the outset, does that mean that you're basically saying the deadline is maybe the next time we ratchet it up? Or are you saying that we're hunkering down for our $825 million strike fund to make sure it lasts as long as possible with each of the members receiving $500 a week?
F-150s, you'd have to imagine, is like the last chess piece to move. F-150s.
Honestly, to me, I was looking at the list of things, and it's basically what's cool and what's not, right? I mean, it's sort of like the cars are going after, like, they're profitable, but they're not like the F-150, and they're not like the Silverado, and they're not like the Ram pickup, and you have to wonder if they're basically
But does
picking
that
this up.
say what Detroit and Dearborn have really become, which is purveyors of $80,000 pickup trucks?
Yes.
Is that really what it says?
Yeah.
And leaning harder into that direction.
Exactly.
Tom.
And man, I remember my first CEO interview at Bloomberg was with the wonderful Rick Wagoner, economics, Duke University, and it was just real simple. He said we'd given up building small cars. It's just that simple.
Yep,
and
there's
that's
gonna
where
be
Joe Biden is in this strike.
a ton more on this, and maybe we'll hear from Joe Biden, the president, out of the White House a little bit later this morning. Let's talk about the ECB. Governing Council member Mattis Muller seeing further rate increases as unlikely after the central bank raised interest rates for a 10th straight meeting yesterday. Muller writing, quote, "To the best of our knowledge, no further interest rate hikes are expected in the coming months. Interest rates have already reached high enough to be expected to bring inflation back to close to 2% in the Eurozone over the next 2 years. That comes as the FT reports that more hawkish policymakers at the ECB could push for another rate increase in December if wages keep rising and inflation proves stickier than expected. It's pretty obvious right now there is a split at the ECB.
I'm shocked.
President Lagarde talked about it in the meeting yesterday in the news conference. One thing we didn't talk about yesterday, everything that was going on. In the mix of all of that, Betty talked about there was a rate cut in China. Some good news for China's economy overnight, with industrial production and retail sales growth jumping almost 5% last month from a year prior on the back of recent government measures to spur more household spending. Weakness in the property market remains. Property investment slid 8.8% in the period from January to August. Bramo, we had retail sales, downgrades to airline outlooks, the ECB, take your pick. What we didn't talk about was China and the fact they're still easing.
Which to me is, okay, a good thing. Some of this was expected. The fact that Chinese home prices dropped more than before they started stimulus isn't exactly auspicious. And some of the investment was also down. My question is, for Europe, we're not seeing we are seeing a little bit of a boost in the euro. Maybe it's on the heels of some of this data. But does this bolster oil prices more than it bolsters the outlook of Europe?
That goes back to the
sort of
demand
the push-pull, yeah.
You've been great on this, talking about the demand microeconomics of oil. And, next week, Christian Malek scheduled to join us from JP Morgan.
That's going to be cool.
That's the oil discussion next week.
Out of London next week. TK, President Lagarde talked about this in the news conference. Just stuck in the worst of places right now. She had to talk about China. She had to talk about energy prices. They've got to talk about a weaker growth profile, the prospect of higher inflation sticking around for longer. Tom, for all the wrong reasons, they had to hike interest rates yesterday.
Michael Spence there's a book out right now. Alarian and Mike Spence is involved.
Crisis.
Yeah,
Spence, Alarian.
This is Michael Spence territory, folks, talking about the convergence of everything that's going on and what it means for growth that we live and try to live each day. For a brief on this right now, Neil Shearing joins us, chief economist at Capital Economics. Let me get the Excel spreadsheet out of the way, Neil Shearing. Did you adjust your spreadsheet off of Lagarde yesterday?
No, we didn't. We've been saying since actually March of this year, we thought the ECB rates were going to 4%. Looks like we've got to 4%. It looks like this is the peak. Big question, of course, is how quickly they come back down from there. I don't think that's a story till right to the back end of next year.
I mean, the arch of economics here is tangible. Michael Spence and I had the privilege once of talking, my great privilege to talk to Professor Spence about, he was a student of John Hicks, which is, folks, that arches back over 80 years of economics, even 100 years, some early Hicksian economics out to Michael Spence. Now, the fact of the matter is everybody likes to talk finance, interest rates, and the rest, but it redounds back to the IS curve and the real economy. What did you learn yesterday about a fractious ECB and how they will address a growth slowdown?
Well, you're right. You alluded to it earlier in your discussion that the ECB is stuck between a rock and a hard place. On the one hand, it's got inflation that's coming down, but it's coming down more slowly than it would like. It's got oil prices now it's having to contend with $90 plus on the oil price. And of course, Europe being a big net energy importer, European natural gas prices also up. On the other hand, the economy is really struggling, not just the Eurozone economy as a whole, that's doing kind of muddling through, but the German economy is really in the doldrums and manufacturing in particular. So weighing these two things up is incredibly difficult for European policymakers right now. I think the judgment is that their judgment will be that they've probably done enough when you consider the lagged effects of monetary policy. That's the other unknown here. But really, they're in the dark.
Which raises a question of whether the end of rate hikes is actually a positive for the economy or negative. We almost saw a sigh of relief yesterday when people got more comfortable with the idea that maybe central banks are done and we're entering the period of the great pause. Is that a bullish thing right now, given everything that you just said, particularly with Germany?
Well, on the face of it, it could be a bullish pause. It could be bullish for the markets. But I think the flip side of that is that the reason I suspect central banks are now pausing, the Bank of England's probably still got one more hike to come next week, but most central banks are, I think, probably done hiking now. We've yet to see the full effects of the previous tightening come through into the real economy. And I think we'll start to get more evidence of that over the next 3 to 6 months. And of course, as the economy weakens, that means corporate earnings are going to weaken. That will feed through to the equity market. So it could be a bullish story for 2024, the back end of 2024, once inflation's a bit more under control. Central banks are starting to unwind some of that tightening, cutting rates. Second half of next year, I would think, looks pretty good for the equity market. But we've got a challenging few months to get through before we get there.
So a snarky commentator who watches the show sent me this message. The U.S. innovates, China imitates, and Europe regulates. And there has been this concern that the regulation and the sort of late to the game sort of, questioning and jawboning of Europe is going to leave it behind in all the technological advances that people say will get us out of whatever muddle we are in. What's your view on that? I mean, is Europe going to be permanently left behind as a result of hemming and hawing and not really having conviction behind some of the latest technology?
Well, good question. I think the first point to make is that we've done a lot of work at Capital Economics. We're about to release a major report on this. We think AI is and should be considered to be a general purpose technology. That's important because those GPTs are transformative in terms of productivity growth and economic growth. Second point is that the US is undoubtedly leading the way and will continue to lead the way, not just in the innovation, but importantly, diffusing that through the economy. So it's not just innovating the technology, building it. You've got to get it out into the economy. The US on every metric is leading the way on that. But I don't think it's so simple as saying the US innovates, China's somewhere in the middle and Europe's well behind. Actually, China's doing a lot of the innovation, but the diffusion of this technology, and in particular, the ability of its economy to adapt to some of the challenges, is much more limited than the US. So I think it's an area where the US is going to lead Europe, but it's also going to lead China.
Neil Scharing, the day that Capital Economics first published, it was about trenchant thought pieces, trenchant notes that you were like, damn, I've got to read this. Where are we a year from now? Give me the Capital Economics note you're going to write year end about where we're going to be 3 and 4 quarters out. Do you just assume diminished nominal GDP globally?
I think what's happening is that the next 6 months is going to be pretty challenging for the global economy. China is not a cyclical downturn, that deflationary bust, but it's much weaker structural growth, and I think that's something the global economy is going to get used to. I think the US is going to flirt with recession over the next 6 months or so. Europe, if it's not already in recession, I think will probably fall into a mild recession. So we'll go through the cyclical downturn. Then the question is, what does the next regime look like? How rigorous is the recovery? And I suspect that once we get some of these new technologies through AI, I suspect some of the kind of medium-term bearishness over economic growth and productivity, particularly in the US, but also perhaps in Europe, is a bit overdone. China has its own structural problems, but I can see a future where economic growth in the medium term is a bit better than the consensus expects.
A better future, Neil. We welcome that. Neil Shearing of Capital Economics with a better tone going into the weekend. How about this? Triple-digit crude is already here. Javier Blas of Bloomberg Opinion joining us next on this programme. Here's the lead paragraph in his column this morning. In the world of crude, there is no such thing as the price. There are dozens of different measures, one for each variety of crude. The financial market focuses on two, Brent and West Texas Intermediate. They suggest a price hovering around 90. It's what we see on the screens right now. But from the perspective of Saudi Arabia, oil is already touching $100 a barrel. TK, that conversation up next.
I made a chart years ago. It was picked up by the FT. It was used by the IMF, and it's off the series Javier is talking about, which is Saudi Light. I call it the Daniel Yergin chart because it goes back to his magisterial, the prize. It is oil back to the time of Nixon and before Nixon, not 1938 when the Americans showed up to discover oil for the Saudis, for the Saud family, but it's the important series. This is Javier Blas, the pro, and he's looking at the pro series.
It's deeply, deeply thoughtful stuff, Bramo, and the politics of it, absolutely fascinating. Ultimately, the Saudi Arabia is allowed to charge a premium for its crude because the Europeans have to back away from the crude supplied by Russia, and here we are, triple-digit crude out of Riyadh.
Yeah, and India, I'm sure, is importing all the cheap oil from Russia and then refining it. This is sort of the moment we're in where Europe just keep taking the hits. I mean, my goodness.
Big time. It's getting more and more painful. Brent crude 94, WTI $90 and about 50 cents. Javier Blas of Bloomberg Opinion on the commodity market coming up next. From New York City, this is Bloomberg.
Just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
The Saudis have always been very cautious about avoiding demand destruction episodes. And certainly, I think they will become cautious again if prices break through $100 a barrel, because as we saw last year with gas, with natural gas, if prices do get out of whack, you can lose a lot of demand. So you have to be careful what you wish for. If prices move up too fast, you can end up hurting consumption.
They're moving up very fast. That was Francisco Blanch, the head of global commodities and derivatives research over at Bank of America, joining us a little bit earlier this week. $94 Brent. WTI right now through 90. Highs we haven't seen for the whole of this year. A new high for 2023 on WTI, $90 and about 60 cents. Up on the session by about 0.5%. It's EK, crude getting closer and closer to triple digits. But according to Javier Blas in Riyadh, we're already there.
Long ago, Stuart Wallace helped build this out. Bloomberg Hydrocarbons, and the leadership has been Javier Blas, writing for Bloomberg Opinion, and of course the book award-winning The World for Sale. Mr. Blas joins us this morning. Javier, I want to get away from market economics, and I want to talk about the culture and fabric that you wrote about in The World for Sale. If you interpolate out $100 Saudi Light, what does it do to the royal family? What does it do to the fabric and culture of Saudi Arabia?
Well, what it does for the royal families, they immediately became very popular. You saw it on the G20 a few days ago in India, where President Biden was again shaking hands with Mohammed bin Salman, the Crown Prince of Saudi Arabia. And using the own words of the president, of the U.S. president, he wanted to make of Mohammed bin Salman a pariah in international economics, and now he's shaking hands. $100 just transforms the Saudi royal family into a mass need. It's someone that everyone needs to talk, everyone needs to debate, because $100 oil is going to have profound economic implications just when central banks are trying to decide that whether they have done enough for inflation.
Javier, President Biden is going to speak of an auto strike today. He and I remember when there were a lot of VW Rabbit diesels sold in America and Detroit was hammered. And then 1986 happened and OPEC was broken. The price plunged. Is there any ability to break OPEC Plus, to break the Saudis in 2024?
No, I don't think so. I think that OPEC and OPEC Plus, particularly this joint agreement between the Russians and the Saudis, is still very strong. And the Saudis have absolute control of the market right now, both on the upside and on the downside. They have demonstrated that they have the ability to push prices much higher than many have anticipated, and they can do the other way down. They demonstrated only a few years ago that they are willing and they are capable of sometimes crash the market if it's needed to punish rivals or to force the collapse of U.S. Domestic oil production. So I think that they are really on the driving seat.
How much does the price of crude operate on a lag? And I guess maybe I've been tied up too much in monetary policy, but this idea that if Saudi Arabia is cutting production at a time where we're heading into a bigger consumption period, whether it's the holidays or whether it's heating, that you're going to see a rapid spike in prices as inventories get depleted that much faster. How much is that a concern?
There is a concern, and certainly the Saudis have to cut production to bring the price where it is today. But let's not forget that production from unexpected sources have increased significantly this year. We were not expecting a much of an increase in production from and exports from Iran. And however, Iran is this year the second largest source of incremental oil supply into the market, only behind the U.S. shale industry. The Saudis have cut production to accommodate, in some ways, the return of Iran and making sure that the price remains as high. But looking at the demand side, it is just fine. We are at record high demand above pre-COVID levels. Demand in China looks robust. It's not as it was in previous years, but it's still doing well, gasoline and jet fuel in particular. And elsewhere, the demand perhaps is not just spectacular, nothing to write home, but it's healthy. It's nothing to panic.
At this point, there were some hopes that during the G20, you would hear about a meeting between President Biden and Mohammed bin Salman, maybe a fist bump, something to give a sense of, OK, is there going to be some pressure by Washington on Riyadh to maybe ease off these cuts, increase production? There was a handshake. There wasn't much else. Have we gleaned anything from what happened in that meeting?
No, nothing from that meeting. And it's quite surprising how silent the White House has been with the Saudi production cuts and the fact that we are back to 100 levels. Gasoline and diesel prices, in particular diesel in the United States, are climbing very rapidly. And the White House has not said a p about what the Saudis are up to. I mean, in the past, you will have press secretaries denouncing the maneuvers. And I think that that's the main reason for that is all the political maneuvering and diplomacy that is going on between the United States, Saudi Arabia, and Israel for some kind of diplomatic deal between the three sides. And that's, to me, the main reason why the Biden administration has been relatively silent on $100 oil.
Javier, how small is the Strategic Petroleum Reserve in America now?
Well, it's the smallest in 40 years. We used quite a lot of last year. We have not bought back. The White House keeps saying that we are going to buy, but it's not happening. And by the way, it looked at that time like a very smart trade, perhaps the best oil trade made. You sell the SPR at very high levels in 2022, buy it back in 2023 at much lower levels. WTI is more or less where it was a year ago when we were selling the SPR. That trade is off, and now potentially, rather than making a big profit, the White House may end just losing money is if it needs to buy back barrels. But so far, there is no indication that the Department of Energy of the White House in any rush whatsoever to refill the Strategic Petroleum Reserve. All the purchases that have been made so far are very, very small.
So from your perspective, how vulnerable is this country to a price shock, a supply shock? Javier, given that production in America is very close to all-time highs and the SPR is so low?
Well, it is more robust than it was 20 years ago because it has a lot more domestic production. That's without doubt. And we think at the time that President Biden had been in the White House, U.S. production has to continue to climb to an all-time high. But if we were to have to do something similar to 2022, we have one final bullet into to be used.
Right.
That's as much as oil as is back on the SPR. We use a lot, and there is not much left.
Javier, help me get ready for next week. We have Christian Malik of J.P. Morgan in his really magisterial study a year ago of over $100 oil was based on emerging market demand. In your study of this and all the resources you have, is there a resiliency and growth to emerging market barrels per day?
There is still, if we look at oil demand in China, in India, elsewhere in Asia, they are consuming a lot more oil than in the past, but they consume a fraction of what Europe and the United States do on a per capita basis. And yes, those countries will perhaps skip a technology and may not use as many gasoline and diesel cars as we have used in the West because they will move to electrify. But you see where the population is growing, where the economic growth is coming in this planet, that's Asia, that's Africa, that's Latin America, and there is going to be more need for energy. And I think a lot of that energy is going to remain fossil fuels.
Javier, this was great. Fantastic column. And on Bloomberg today, Javier Blas there of Bloomberg Opinion on triple-digit crude out of Riyadh. Sarah Hunt of Alpine Saxon Wood's going to join us in about 6 minutes' time around this table here in New York. She is constructive on energy stocks. Looking forward to her thoughts on this. And later on today, an interview you do not want to miss with AMH and Joe Matthew, the former Vice President, Mike Pence, TK. That's just around the corner.
Joe and Anne, we're going to frame this out. This is the guy from south of Indianapolis. It's a triangle of Indianapolis, Cincinnati, and Louisville. He's Indiana throughout, and also he's had trouble raising money. It's fascinating to me that this guy, this visible, this successful, and the Republican Party is going around hat in hand. That's got to be the first question.
And the perfect opportunity, Tom, to talk about UAW and this strike. This very targeted strike at the moment. And Lisa, the quiet, the silence coming out of Washington, D.C. this morning. I get it. They like to sleep. I understand that they wake up later.
The morning starts at 8:30.
I know one of those things.
It starts at 8:30.
But you would have expected immediate reaction coming out of the White House for something so unprecedented as this.
Saying what? Right? I mean,
That's the question.
This is the difficulty. What do they say? We stand behind the union and not the auto manufacturers that we've been talking to extensively to put forward our plan?
Let me frame it as follows. What would the most pro-union president in the history of this country say, Tom? If you were as pro-union as that,
he would say this is a modern non-strike. It is the surgical strike of 3 factories, 3 automobiles, and as Craig Crudell says, it could morph into the strike that they're comfortable talking about.
There is no good way that he can respond to this. Really, there is absolutely no way he can avoid serious criticism because on one hand, he has framed himself as the most pro-union. On the other, he's talked about, build back better. He's talked about the whole new energy sphere.
Friends with Mary Barra.
Exactly. It doesn't work. And there is nothing good that he can bring together, these two ideas.
Lose-lose, so just stay silent for as long as you possibly
That's what I do every day.
Look, at some point we're going to hear from the White House today, and let's see what this president's got to say. Sarah Hunt of Alpine Saxon Woods joining us next on this energy market. AMH in the next hour as well, live from Washington, D.C., with energy prices at new highs for 2023.
The context around European growth has changed.
There are really across the board weakness in the euro area to a lesser or greater extent.
Recessionary risks do linger as we move into next year.
I think it's harder to see higher inflation if growth is weakening in the euro area.
I think the Fed so far has done a pretty good job. I think the ECB isn't quite there yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The words that rock Detroit, we will strike all 3 of the big 3 at once. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market on the S&P slightly positive on the S&P 500 by 0.1%. TK, it is our top story. Strikes in America.
It's got to be a top story, but it's a different strike. I was thunderstruck. Bramo nailed this yesterday. She said, pay attention to 10 p.m., and she was absolutely right. There, I was watching Twitter or whatever. Afterthought came in late partying, and I'm up watching and the whole thing, and there it was. This is a hyper surgical strike. This is a strike I've never seen. This is a strike Joe Biden has never seen.
Elisa, it's 12,700 workers across 3 plants.
There are 3 ways to interpret this. Number one, this is digging in your heels for a prolonged strike where you can allow your $825 million strike fund to last. Number 2, this is just the beginning, although it's probably just pushing out the deadline and you're going to negotiate, or something in between. The difficult part for me is, what is the red line? What are they looking for? We've already seen quite a few concessions.
Tom, it is not the F-150. It is not the Silverado. It is not Ram pickups, but that's in the back pocket if they want to escalate this even further.
But are these the cool cars? I mean, it's the Bronco, the GM Colorado, the Stellantis Wrangler. I can't believe I'm saying that. Doesn't work. The Jeep Wrangler,
no,
folks.
That doesn't work at all, does it?
It doesn't work. There was Stellantis Wrangler. And there's another issue here, which I mentioned in the last hour. Bring it up, if you would, on radio. It's my childhood. It's a 1968, 1969 Ford Bronco. This was my ute. This is all we drove at home. I'm serious. And John, Joe Biden's auto company made a $2,100 Bronco. The one you would own now, the one only you could style in, or Bramo, $71,000.
Yeah, that's before you start adding stuff on.
No, that's a peak one. That's a peak one. It's like a $41,000, but you gross it up.
You can push
$71,000.
You can push it up.
These are expensive cars.
Expensive.
Is this Joe Biden wants this to be about America? Is it, or is it about building fancy cars for a narrow segment?
Tom, it's increasingly expensive to own one. That's for sure. At a time where inflation is still a problem in this country, and maybe in our future a labour market that's a whole lot softer. The good news is this labour market is still strong. What's the message going to be from this White House later on today? Tom, later on this morning, when you come out and say you are the most pro-union president in the history of this country, do you have any choice? Do you have any choice whatsoever than just to back the UAW and go against Detroit's Big Three?
Go against is a key phrase. Or Bramo, what do you think? Is he going to go against it? You mentioned earlier, Mary Barra. Is he going to go against Mary Barra? Is he going to go against Dearborn that didn't go bankrupt? Is he going to go against the French? And how do you pronounce it? Peugeot?
Peugeot. There is one playbook for him to come out and say, I trust that both sides will negotiate in good faith.
Oh, there it is.
I am looking for, it's important for workers to have rights. It's also important to have a viable auto manufacturing sector. I'm keeping in close contact. And let cooler heads prevail. And that's what we're going to hear. And then he's going to get on the phone and be like, come on, figure it out, guys, please.
If that was the statement, fantastic. That's not the statement, the words that come from the most pro-union president in the history of this country. I don't think you get to put out that statement and then go on a campaign trail and say all those things.
Not mentioned in, the emotion.
But ultimately, he's a politician and can do whatever he wants. But I'm just saying it's hard to square that circle.
Is this about a 32-hour work week? Which is like completely un-American. It's like completely French.
Tom, I think it's about all of the above. A lot of the rights that were lost going into the financial crisis and coming out the other side.
Yes.
There's a feeling that over the last decade or so, a lot of these workers have been left behind.
Yes.
And this is a once-in-a-generation opportunity to take a first step. I think this is really important, a first step towards doing something about that. There's a greater feeling, Tom, that this ain't it. This isn't it, and once you're done with it, it's over. That this is the start of a process,
Our Craig Trudell was fabulous on it. He lived it in the heart of Michigan. I lived it on the edge with Rochester Delco. But the union effort in the automobiles of our childhood gave us the middle class. Honestly, I don't know if Coventry was that way in England, but here they handed America a prosperous middle class.
It's a limited strike so far, and the automobile companies in the pre-market, they're doing okay so far. Equity futures on the S&P positive here by 0.1%. Yields are just about unchanged, higher by 3 basis points at 432. And there's crude, Lisa, screaming $90.51.
It's a light day of data ahead this morning, 8:30 a.m. We get September Empire manufacturing data. It's been messy, but maybe a read on how things are playing out there, as well as 9:15 a.m. industrial production. 10 a.m. a read on how much those higher oil prices that you're mentioning, John, are affecting sentiment. University of Michigan Consumer Sentiment Survey. And at 10:05 a.m., do not miss this, our own Maria Tadeo interviewing the France economy minister, Bruno Le Maire, after a discussion already with Nadia Calvino of Spain. There is a lot of dissent among the finance ministers of Europe who are meeting alongside Christine Lagarde about whether it was a good or a bad idea to hike yesterday.
25 basis points, divided, a split on the governing council and the euro, weaker potentially for a 9th consecutive week against the dollar.
Did you get out of your ARM shares at 66?
I wish I had done.
I saw that. I thought of you yesterday afternoon.
Quite a pop we got yesterday.
Yeah, pop,
we'll touch on that in about 25 minutes. Sarah Hunt with us now, Chief Market Strategist at Alpine Saxon Woods. Sarah, wonderful to see you. Let's start here. Give us one good reason to buy GM, Ford and Stellantis with this going on.
I think that's a very difficult question. I mean, you'll see that the stocks are only a little bit lower in pre-market. It really is going to depend on how long this takes to work through. I think there's a lot of things that are on the table. I think job security is definitely part of it for the union. And I think the real question for those three is how you continue to be competitive globally when you've got these issues going on at home and you've got issues with higher oil prices, right? Because those cars are more expensive not only to buy, but to fuel right now, too. So I think that there are a lot of problems right now in the auto sector. And I think for those three in particular, this is not a great time for them to be facing this sort of action.
The emotion here of a president today goes down to the manufacturing multiplier. Years in my youth, where it was simple. A manufacturing job was better than being a TV anchor because it was more productive for America. Is there a manufacturing multiplier still in this nation?
Well, I think there's definitely a manufacturing multiplier, and I think that the targeted strikes are showing you exactly how, when you've changed the manufacturing to each plant does a different thing and gets it to the ultimate end assembly, that I can strike anywhere and I can have a big effect on a giant network in a small way. So there's definitely a problem there. And the question about manufacturing, we're trying to reshore manufacturing, right? So this is part of, I think, the big labor question of when I reshore manufacturing, what's going to happen to prices? And I think globally, we're setting ourselves up between energy situations and bringing production back home to have just higher prices across the board. So I think that there's a longer big tail here to some of these discussions that are not just about individual micro situations.
But AI is going to solve it all. It's going to create robots and all sorts of programs that can just make all of the things that we need. I mean, this is sort of the great hope to keep pricing down. Why wouldn't you just hedge your bets and go strong into energy, go strong into tech, and forget the rest of it?
Well, you know, we've been positive on energy, and that has not been the best thing to be all year, but I think it's finally starting to come around, and it's actually coming around almost too quickly because oil prices have risen so quickly that it's almost an issue. But I think that that's part of the problem for the general populace, is that if I am going to do this with robots, if AI is going to save me from a productivity standpoint, then how am I going to have job security? And I think that that's part of the tension that's going on right now, especially with the automakers.
Elaborate on that. Why do you say almost too quickly?
Because it does have demand destruction issues, right? When oil prices shoot up dramatically, you do start to see demand destruction. And part of the reason oil prices have gone up is because the Saudis are taking oil off the market. And at a time when we've essentially depleted our SPR. So there isn't a lot of backstop in terms of excess production of oil. And especially with the U.S., as John pointed out earlier, at record highs for production. So I think that movement higher is not, the stocks haven't caught up to it because they don't really believe it, right? So from an investment standpoint, you're not getting the benefit of those high oil prices, but you are seeing them on a consumer problem, as a consumer problem.
35% move since June on crude has been quite a move, Sarah. Do you see these multinationals, these big oil integrated companies, leaning harder into fossil fuels? There's a big conversation about where BP is going in Europe, where Shell is going in Europe. What are the US players doing in energy?
I think every single one of them is trying to find a way to be both relevant in fossil fuels, but also to look towards a future where fossil fuels play a smaller part. The question really is the timing on that. And I've said before that I think that tail is a lot longer than people want it to be in terms of what what countries are trying to legislate and also what people would like to see. But the truth of the matter is that you do need fossil fuels, and you're going to need them for a longer period of time. And the earlier discussion about emerging markets, that they're not going to be able to transition to electric all that quickly. The infrastructure isn't even there. So as they grow bigger, their demand for oil, even if it's coming down in OECD countries, it's going to be going up in other places.
I got airlines flat on their back. Airlines have been a post-pandemic disaster in terms of shareholder return. I've got Exxon with 3% dividend. Okay, generous, I guess. The 5-year dividend growth rate is totally unacceptable. Are they going to get used to cash religion? Are they going to become like Apple and start throwing cash back?
I wouldn't want to opine on Exxon specifically. I think some of the other oil stocks have definitely gotten religion on the dividend and return of capital to shareholders, because I think that was something that they've been told by Wall Street and by investors that they want. They don't want them to go out and spend all this money on production when oil prices are not as high as they were right now, but they would like to see some return of capital. So I think that there has been some change in the way that capital allocation is looked at across the industry.
Does it matter who's in the White House when it comes to the energy patch? We make a big deal about policy coming out of President Biden, former President Donald Trump. Crude's back in the 90s, but crude production in America is close to all-time highs, Sarah, and that's happening with this very anti-fossil fuel tone coming out of the White House. Does it even make a difference what they've got to say?
It makes a difference when it comes to permitting, and it makes a difference when it comes to production that you don't have yet, right? If you're looking at an area where we've been able to extract a lot more oil out of fields that were already there with the technology changes, and that's where your productivity comes in, then it matters less. When it comes to looking at new areas to be able to either explore or drill, then it starts to make a difference on the edges.
Sarah Hunt, thank you. It's good to see you here in New York. Sarah Hunt of Alpine Saxon Woods. Construction on energy for a lot of this year, and the market, Sarah, is starting to come your way in a quicker way over the last couple of months. If you are just tuning in, welcome to the programme. Lots to talk about in this market, including this move in crude. We're in the 90s on WTI, highs of 2023, $90 and about 50 cents. For Brent crude, $94 a barrel, wow, up by 1/3 of 1% in today's session. In the equity market, we're positive here by 0.13%. Barry Knapp's coming up a little bit later. That's in the next hour and about 50 minutes from now. Down in Washington, D.C., up next on this programme, TK. AMH, our chief Washington correspondent, on the latest in Detroit and what we may or may not hear from this White House later on today.
And also what she will hear from Vice President Pence tonight with Joe Matthew, an important conversation, not only on politics, but of the UAW of Indiana and north to Detroit.
What do you want to hear from the VP, former VP, later on?
I would like to know how he's going to find the ability to support the other selected Republican candidates because he can't raise money. Bob Dole was a distinguished, earned World War II veteran. Yes, he did run for president, but Bob Dole never connected with the greater American populace, and that's where Pence is.
Lisa, that field is still big, and that spread between the former president and the rest is getting bigger, not smaller.
And if you take a look at who's gaining popularity, it's the candidate Ramaswamy, who is basically,
who's gone on to TikTok.
And he's even more Trump than Trump, which is amazing,
Sarah,
right? Considering some of the controversy around TikTok.
What is this guy doing? Are you kidding me?
He's gone on to TikTok. Have you seen that?
Yeah, exactly. Well, that's the smartest thing I've heard on the guy.
Well, hold on a second.
You think it was a smart move to go onto TikTok?
No.
Okay.
I think it's an embarrassment. We're running for president thing.
Where's the surveillance cork? I mean, look, I will say this.
Yeah,
that,
exactly. Thank you, Lisa.
Anytime. I'm here to have your back. The whole idea that the only way to gain popularity is to out-Trump Trump. I mean, that seems to be the concept here.
Stop. I've walked by. I've never been in it. I've walked by the Situation Room. You look through the little glass and the Marines standing there ready to shoot you. Can you see that guy in the Situation Room at the White House?
Headline across the Bloomberg. The president to deliver remarks on UAW and the automakers' negotiations later on today. Just looking for a time, and hopefully I'll find one for you. Coming up very shortly, Bloomberg's Anne-Marie down in Washington, D.C. From New York, this is Bloomberg.
day one, we told these companies, we don't expect them to delay and drag things out, and that's what they chose to do. We didn't want to be here. We want a fair agreement. We want fair economic and social justice for our members. That's what this is all about. They've had a decade of record profits. When they're profitable, it's all theirs. But by God, when workers ask for their fair share, it's the end of the world.
The strike is on. President Sean Fain of the UAW joining the picket line in Michigan. The latest from the White House in a statement moments ago. President Biden will deliver remarks on the contract negotiations between the United Auto Workers and auto companies. Those auto companies in the pre-market, GM, Ford and Stellantis, are doing okay. It's a targeted strike, Tom, so far across 3 plants for a little more than 12,000 workers.
Let's get right to it right now. Too important of a conversation today. And one of the most important treatments was John Farrow's repetitive conversations with a guy missed this morning in this administration. And John, that is Martin Walsh, union representative, Boston, Massachusetts, former Secretary of Labor. Boy, is he missed this morning.
And doesn't have an official replacement as yet. Julie Sue not confirmed, Tom. There's a lot we need to hear from this administration this morning, and hopefully we get some answers on what their position actually is later on today.
Amory Horton joins us this morning. That is important. Amory, I'm just going to cut to the chase. What will the president say this morning? How is he being briefed by his cabinet and administration?
What you're going to expect from the president, I imagine, is what we heard from him a month ago in a statement when there was 1 month left on this contract. And what he called for was a just transition and that the auto companies make sure they are paying a good living wage for union workers to be able to support a family. So he's going to be walking this fine line of making sure he is still, of course, wanting to have this policy goal of electrifying the grid and support for the EV manufacturing, but at the same time, wanting to make sure he's seen as a president that's fighting for labor inside the government.
Has this strike grabbed the nation? I can't believe this morning he's going to vamp into a political ballet on EV and grid transmission, say in Oklahoma and Texas. In the old days, there'd be no other story except the strike and the potential violence of the strike. Is that not true this morning, Anne-Marie?
Well, you're absolutely right. I mean, what you're seeing from Sean Fain, this stand up and strike, is reminiscent of the sit down strike of the 1930s, which many would have said was the strike heard around the world, which totally took not just the United States, but the world by surprise and what was going on at manufacturing plants like GM. So what you see as Sean Fain do is really try to harken back to this time in the 1930s. He's trying to really revolutionize and revamp what the UAW is today. At the same time, we do see him trying to make sure he's protecting the strikers' fund by targeting these plants. But this is going to be top of the agenda for the president, not just for the fact that he continuously says he wants to be the most pro-labor union president in history, but also for the fact that this could mean a recession in Michigan. Michigan, Trump won. He was the first Republican to win since the 80s, and then it flipped to Biden. This is a key state for the Democrats in November of next year.
MH, can you give us a sense of how deep the pockets of UAW are? This is very targeted. It's 12,700 workers across 3 plants. Just to give us an idea of how far this could go, how big this might be.
Well, we spoke to Seth Harris last night, who used to be an aide to President Biden when it comes to labor. He's actually the individual that helped him coin the term that we continuously repeat from the president, that he wants to be the most pro-union president in history. And he said that he thinks this could last weeks, not days. Potentially, that's the kind of money the UAW has right now. But that is why, Jonathan, they're doing this targeted strike. They don't want to make sure they burn all their cash at once, and also want to make sure that they could support their workers because they're going to be paying out of the UAW strike fund to support these workers. So what he thinks is that this will last for weeks. That's going to be very challenging for the president in Washington, D.C., because this might end up being coupled with a government shutdown. The U.S. government runs out of funding September 30th. And Anna Wong of Bloomberg Economics says if you put together higher oil prices, strikes in Michigan, and the other states that have these plans, but really Michigan, alongside a shutdown in the U.S. government, that could mean the difference of a recession or not.
At the crosshairs of this debate, and what I'm hoping to hear from President Biden is something about the electric vehicle policy that he has, because this is really at the crux of some of the concerns by the union. Just to give you a sense, most of the EV factories are not unionized, and typically electric vehicles and their parts require fewer workers, which means fewer unionized members and fewer jobs. How much can he back away from what he has put out there in terms of the move away from traditional automaking?
Well, you can't back away from it, right? There's money flowing out the doors from Washington from federal spending and grants and tax rebates if you move to the electric vehicle industry. Lisa, and it's not just the fact that an EV requires less individuals. The plants are also, for the most part, being opened up in the South, in right-to-work states where it is illegal to unionize. And the UAW wants to make sure they are part of that transition, which is why at the end of August, you saw from the Energy Department a press release about more money and more federal spending that will go to traditional auto plants that can retrofit for the EV future. This, to me, really seemed like an olive branch from the Biden administration to the UAW to make sure they know that they are not left behind. But as you say, this is the crux of the matter. There's traditional issues at play: pensions, work-life balance, higher wages, retirement. But there's also this tension of Biden's two competing policy goals. That is greener economy on the top of labor unions.
So why has the Republican Party been so quiet on this? Why can't they come out and taken a strong stance one way or another at a time where the Rust Belt and the unionized members are increasingly becoming swing voters?
Well, there's two things. One, not everyone is staying silent. Former President Donald Trump has been asking the UAW for weeks for their endorsement. This is a group that endorsed Biden. Sean Fain said they will not endorse former President Trump next year. But at the same time, at this moment, they've held off endorsing anyone. They are clearly irked by what they're seeing coming out of Washington in terms of policy goals. And Sean Fain has said so much in less polite words. So the former president has been trying to goad them to try to get their endorsement. But when you talk to pollsters, even if you see the top brass of labor unions side with the Democrats and the leadership, you need to look at the rank and file and where they're working. Look at the exit polls of 2016. How many individuals flipped from union households, from Obama to Trump, and did not vote for Hillary Clinton? These are key states. So you will probably start to hear more Republicans come out and speak about this, but they need to be careful as well, because it's those rank and file voters that they want.
AMH, you'll be speaking to one a little bit later, the former VP, Mike Pence, on balance of power, alongside Joe Matthew. What's the focus of that going to be?
Well, there's a lot to speak to the former VP about, but he has already weighed in on what's going on with UAW. And he comes from Indiana, where there are a ton of manufacturing plants that are tied to the auto industry. So he's going to have a on-the-ground sense of what this could mean. And what he had said about UAW, he says if he was president of the United States, he would be sitting people down. This is not just one more contract dispute between auto workers and the big three in this country. And he said it's the failed policy of the Biden administration. So I think he will take a lighter tone than the former president, but he will be on Trump's side in the sense that they think this is an EV glut, and the auto workers should be siding with Republicans come November.
AMH, thank you. Looking forward to the conversation. Balance of power, the former Vice President Mike Pence sitting down with Bloomberg's Anne-Marie. Some comments from Mary Barra of GM to CNBC earlier on this morning. These are the headlines. They think the strike can be resolved very quickly. Didn't have to be here. They're evaluating production changes. We have talked to many members, Tom, of the White House. The latest from GM this morning.
That's the beginning of the communication. I'm sure we'll see it from Ford and Stellantis, Chrysler as well. But the key communication is going to be the President of the United States.
And he will address the nation and UAW, the auto workers, and Detroit later on today. From New York City, good morning. Heading towards a week of gains on the S&P 500. We're up on the week so far through Thursday on the S&P and on the Nasdaq too. Equity futures this morning on the S&P positive by 0.1%. On the Nasdaq 100 down by about 0.1%. In the bond market, yields higher off the back of an upside surprise on US retail sales and PPI, driven to some extent by what's happening in the commodity market. Yields up by 2 basis points on a 2-year, 5.0368%. Back in the 430s on a 10-year. Lisa, back in the 440s on a 30-year.
What happened to all the buyers out there? People who said they were going to come in and yields were going to come in softer. There is a question of what's behind this. Is it really inflation expectations, or is there something structural going on at a time where real yields on the 10-year Treasury are climbing toward the highest levels going back to March of 2009.
10-year real yield just popped 1.98%. If we go into Friday here and go into the weekend and pop over 2, that's a huge deal.
The data's better in America against expectations, and particularly relative to what's happening in Europe. President Lagarde in the news conference yesterday, very, very sluggish. The euro just about reclaiming 107 right now, positive by 0.1%. The euro just a touch stronger here, but at the moment we've been looking at 106. In fact, on my screen I think that's wrong where the single currency is on that board. On my screen I've still got the euro at 106.56.
Well, you round it up. That's a 2-digit. There's a difference between a surveillance 4-digit analysis versus 2-digit.
Well, I always want the 4 digits, TK. It's
yeah,
foreign
I agree.
exchange.
Totally agree.
On my currency pair right now, 106.57 on the euro. Just about positive on the session, but down on the week, potentially for a 9th consecutive week. And the move in crude is where the story's at for me. Commodities, WTI, Brent. WTI at the moment, 90.65. Brent crude, new highs for the year on Brent crude at $94 a barrel, Lisa.
And this is on the heels of what we saw, which is better than expected data in China. And that's the worst thing of all worlds, because on one hand, it's going to feed into demand for oil, but not enough to juice growth. This is sort of why Europe is in the midst of a toxic
Unreal.
brew.
A very, very toxic brew, Bramo. Under surveillance this morning, the United Auto Workers starting an unprecedented strike at all of the big 3 automakers. UAW President Sean Fain saying, quote, "This strategy will keep the companies guessing. It will give our national negotiators maximum leverage and flexibility in bargaining. And if we need to go all out, we will. Everything is on the table." President Biden said to address the strike later on today. Tom, no time, but from what I understand from people down in Washington, no time because they're not sure what they're going to say about this just yet.
I wonder if he's capable of stripping away the mythology that he grew up with, because the strike that I saw last night is not the mythology of the American labor economy. It is a new phenomenon we're seeing this
Muted
morning.
price action this morning. Do you think it's a coincidence, Lisa, that Tesla's having its best week of the summer, going all the way back to June?
I would guess not. And I would guess that also Tesla's been absolutely rocking it on all sides, no matter what happens. So they've had an incredible year. But this to me is really at the crux of the issue, which is the electric vehicle makers and the ones that aren't unionized are going to cash in on this. And that's the real risk for GM, Ford, and Stellantis.
Very scientific.
I can't even say it.
I see a lot of Teslas on the street.
Yeah.
That's a fact. That, small matter.
Agreed. And the stock is positive this morning in the pre-market. Our next story from ARM climbing 25% in its trading debut. The chip designer raising $4.87 billion in the year's biggest initial public offering.
Woo.
The company selling 95.5 million ADR shares at the top end of the range, 47 to 51. Do you think it's accurate, Lisa, to say they raised money off the back of this IPO, given the nature of the transaction?
Yeah, basically it was a fundraise, right? But it was also a marketing tool. I mean, you have to imagine this.
Yes.
But to put some numbers on it, they could have priced it at $52 a share. They priced it at $51 a share. Masayoshi Son came out and said, we don't want to add the extra dollar because we want it to be a big pop, big boom. Look how well SoftBank is doing. Our tech investments have been rocking it.
Okay.
They left $100 million on the table because
this is some really good research on this about how these IPOs,
That's all I think
work.
Of.
But how these IPOs work out. There's been a lot of good research on this as well. Guess what? There'll be a first earnings call. That's when it starts.
To Lisa's point, they want us to talk about ARM and not WeWork and all the other things. Disney cutting its target for streaming subscribers. The company announcing it will fall tens of millions of subscribers short of its last publicly stated 2024 target for the Disney Plus franchise. This according to people familiar with the matter. Returning CEO Bob Iger saying the company will no longer provide subscriber forecasts following a similar announcement made by Netflix. It is not going well, TK, for Bob Iger this time around.
It's a broken system, but frankly, creative Iger is the one to help out financial Disney. I'm fascinated by this. I was thunderstruck by what was it, the ABC, should I say rumor or speculation of shipping out ABC to
reporting.
Nexstar?
Reporting encouraged by the man himself, I would suggest, by indicating that some of these divisions aren't core to what Disney is trying to achieve.
And I've told this to Paul Sweeney, who's expert on this. I'm just absolutely baffled by it. You know, I just don't know what they do. I look at home, at what gets used. Disney Plus doesn't get used. That's a fact.
Well, but how old are your kids? I mean, that's a key aspect.
Can you run
of
a streaming channel off 8-year-olds?
The point. Well, I'll leave that there.
Tom.
It's a good question. I think a lot of people would say, yes, you can if you look at the consumption during the pandemic. There is a question, though, going forward of whether Disney is basically kitchen sinking it right now and trying to streamline everything with the focus on the parks business and the cruise business, which I know you guys are purveyors of. But this really is going to be throwing it all at the door so they can start over.
The parents in the control room, our producers, already writing in. The answer's yes, Tom. Apparently you can. Just a bit of feedback there, TK.
A little bit of constructive feedback. Tom Keene, the pinata. Joining us now amid this flow, and we're watching from the White House to see when the president will speak, is R.J. Gallo, Senior Vice President of Federated Hermes. And we're thrilled that he could join us this morning because he's got the smartest bond note of the week. R.J. Gallo knows that one of the efficacious things to do in bonds is look at the Bloomberg Total Return Index and see that for all the talk, yap about coupon credit spreads, blah, 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 bonds have gone nowhere. R.J. Gallo hypothesizes that bonds are not back. Thank you, R.J. I looked at the chart off your note, and I was thunderstruck how the blended price of bonds is really not advanced. Is it still a bond depression?
Well, in the note that you were talking about there, I made the point that when we started the year, we felt that it was going to be a favorable one for bonds, and clearly it's fallen short. The Treasury index is basically at 0. The ag is up, I think, 0.5%. So yes, it's been disappointing. I would also note glass half full. The double-digit losses of last year, recall the ag was down like 13%, are clearly behind us. And looking forward, we're much more optimistic that the time for fixed income giving you sort of low single-digit positive returns and acting as a powerful diversifier in your portfolio, that is in fact back. With yields at the highest of the last 12 to 15 years, we think value has been restored, and fixed income investors should think about extending some duration, getting out of cash, legging into fixed income will be a good move over the next 12, 24 months.
Okay, 12 to 24 months, I'm going to get going. When do I get back to the regression line that I had for 30 years? You know, the Bill Gross, great moderation, price up, 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 up. How many years is it going to take to recover from what we've seen the last 2 years?
I hate to say it, but I think that the zero lower bound, presents a significant wall to anything like the returns that we saw over the 20, 30 years leading up to the pandemic. If anything, we believe that it's quite possible that equilibrium yields are higher post-pandemic than they were for the decade plus prior. It'll be interesting to see if the Fed goes there with its long-run dot, maybe inching up in the dot plot closer to maybe 3, maybe a little higher. If you look at forward curves, you can see that the market is there. The market believes equilibrium yields are higher. And in that sense, it's going to be a while before we see big price returns from taking a fixed income, high quality fixed income investment. Instead, I think we'll probably be looking for oscillating markets around a higher equilibrium, which will still provide a nice return and ballast for your portfolio, but it's not apt to be double-digit price returns anytime too soon.
Is this higher yield driven by inflation or driven by something else, whether it's a budget deficit that spooks investors or a changing central bank regime in Japan?
That's a great question. I think that there's been a number of factors that have shifted us towards what's probably a slightly higher equilibrium yield environment. The budget deficit's a big part of it. Sovereign debt has exploded. We've got a lot of debt to roll over. Obviously, we have structural imbalances here in the U.S. that no one wants to deal with in Washington. So that's one factor. I think on the favorable side, a lot of talk about AI, about technological innovation. In the long run, when you have technological innovation, your potential growth rate goes up. Higher potential growth rates, higher equilibrium yields. That's actually a positive thing. That could put more people to work. Of course, you've got to talk about the issues of displacement, who gets jobs out of the new technology, who loses them. But ultimately, I think higher potential growth rates, larger budget deficits, and some pushback against internationalization, the pushback against the global trade marketplace that helped to produce low inflation and low yields prior to the pandemic. Now you're talking about onshoring. That's a big change. And I think ultimately that too is probably going to lift yields a little higher, as the disinflationary impact of globalization might not be as strong as it was in the prior 10 or 15 years.
That's in the years ahead. In the here and now, we're looking at a UAW strike that's roiling Washington, D.C., but also Detroit. Does that factor into your yield call? Does that factor into the bond space as you look out to understand the growth as well as the inflation picture?
Yes, it does. I mean, it obviously it cuts in two ways. First and foremost, these workers are looking for raises. It's no surprise. We've dealt with the highest inflation in 40 years. A lot of workers are looking for raises. That makes sense as they deal with higher cost of living. You stop there, you would think that strikes have to be inflationary. Ultimately, however, you got to consider the near-term impact of a strike is less production, less economic activity, and the multiplier effects that occur in the local economies around these three plants. And if it extends to more plants, that economic impact only grows. I think ultimately this idea of empowered labor across the country is very predictable at a point in time like this. I think it's challenging for the White House, as you guys have been saying. I think from an economic standpoint, I'm focusing a little bit more on the growth headwind that it's going to produce in the near term. It's not the case that every dollar of raises that the auto companies are going to give these workers to get them back on the job, that's going to be simply passed through one for one into higher prices at the dealership where we buy our cars.
I've got an equity question, RJ. Can I squeeze it in? Because I've only got about 30 seconds left with you. Do I want to avoid industries that are witnessing, like we see in airlines, like we see in automakers, this powerful movement from labor?
In terms of what industries you would go to avoid it?
Should I avoid the airlines? Should I avoid the automakers purely because of the evidence of labour market power? Should I avoid those industries?
Well, I do think it's clearly a margin compression story in these industries. As I was saying, the automakers won't be able to pass through to price one for one the raises that their workers are going to get. I clearly think that is a challenge. In terms of sector rotation on the equity side, I don't know if I would necessarily avoid it. That's really not my main area of expertise. I can tell you on the fixed income side, we've been relatively cautious on investment grade corporates and high yield because we think a broad-based margin compression is a story that's still out there, and we're not as optimistic on corporate profits in general. I would focus on that from a broader macro perspective.
Interesting. RJ, thank you. RJ Gallagher there, of Federated Hermes, on some important issues. If you're just tuning into the programme, welcome. Equity futures here positive by 0.1%. Lauren Goodwin of New York Life Investments joining us in about 45 minutes' time. These are really, really important questions. How we think about some of these issues right now, Tom. Not just margins more broadly, but the viability of some of these industries. Helene Becker on this programme yesterday talked about the prospect of one of the big airlines failing, Tom, because they couldn't address these issues in a way that would be profitable for them.
I was wrong years ago. I used to believe in diversification, and Peter Lynch called it diversification. Peter Lynch correct, Tom Keene wrong. And in terms of sectors and industries, you're 100% right. The way you make money is by not losing it in value-trapped dead sectors.
Well, the concept of diversification is changing. And I think that that's really becoming clear. It's those that are hinged to an economy more subject to some of these negotiations and those that are newer and more divorced from it. It's almost the new and the old economies at war with one another.
Yes.
The revenge of labour market power in a big way. Geetha Raghunathan, US media analyst over at Bloomberg Intelligence, will be joining us shortly on the forecast or lack thereof from Disney+. That's next from New York. This is Bloomberg.
Chapek overspent on streaming. He basically was chasing subscribers, not profitability. It takes time to turn that around. You have to buy in Hulu. But I think what we would say, and I think it's fair criticism, is that the communication out of Disney since Bob has come back has been very poor, right? They basically have thrown out a ton of ideas and they teased the market without delivering on what the story actually is going to be.
Michael Nathanson, the senior research analyst at SVB MoffettNathanson. More confusion this morning. Disney cutting its target for streaming subscribers. The company announcing it will fall tens of millions of subs short of its last publicly stated 24 target for Disney+. Your equity market shaping up as follows on the S&P 500. Equity futures still just about positive by 0.1%. Yields bleeding just a little bit higher by 3 basis points to 432. Crude in the 90s. Have we got to get used to that? Crude 90, wow. 61. In the FX market, the euro 106.58 and positive 0.1%, coming off the back of the worst day since July for the euro, Tom, in yesterday's session, given how decent the data was stateside and how bad things look for the ECB over in the eurozone.
Time is wrong. Did you notice that?
That's a new one.
That's a new one. Disney Plus, Animals Up Close, Elemental. It's a Pixar movie.
Okay.
Didn't do that well.
The mail is coming in. Seth Rosen, thank you, Seth, so much for writing in this morning. He says, Tom, you're wrong. And I guess Disney Plus is a big deal. I don't buy it, but
so
I'm
you're
wrong.
surveying 8-year-olds this morning.
The 8-year-old cohort, is
the children of the parents in the control room are weighing
Disney
in.
Plus are, doing better than good. We're going to digress from huge news. And seriously, we still don't know when the president's going to speak, right?
No time just yet, no.
Yeah, okay.
I'm not sure if the president knows what time it's going to be.
We're going to go to Disney Plus and the intractable issues that Mr. Iger faces. Geetha Raghunathan joins right now with Bloomberg Intelligence. And Geetha, to me, this is about fancy companies flying in fancy McKinsey, BCG, Bain people, the strategists to save the day. What would the strategist say this morning to Mr. Iger? Let's pick on McKinsey. McKinsey Media shows up. What do they say to the leader of Disney?
Well, they already have. So good morning, Tom. Thanks for having it. So they already have a lot of things that are going on right now at Disney. So you have, on one side, you have the streaming business, which, as you just pointed out, is losing subscribers. But then the whole narrative there has really kind of shifted away from subscribers to profitability. So that somehow Bob Iger has to show that this business is going to be profitable sooner rather than later. We know Netflix has kind of already set the template in the market. There is a blueprint for streaming profitability. So they have to figure out a way to get there. But more important for Disney right now is to somehow kind of show the market that they have a plan for their linear TV networks. And the linear TV networks have really been in the news a lot over the past few days, whether it was that dispute with Charter and more recently, all of these news reports about them looking to kind of dispose of some of their networks and multiple bidders emerging. So there's a lot going on there. But I think as soon as Mr. Iger can kind of clarify the narrative, it's all going to become much better.
But Geetha, we had Michael Nathanson commenting earlier, and I look at MoffettNathanson for 10 years has talked about cord cutting. And they were correct. And I believe MoffettNathanson would say, you know what, it actually happened faster than we thought. Is Iger listening to the public? Is Iger listening to Seth Rosen?
He absolutely is, and he's been forced to. I mean, the data is staring at you, in the face. So there's no way to sugarcoat the fact that the industry is losing subscribers. We've lost roughly 25 to 30 million subscribers over the past, 5 to 10 years. So that is, the writing is on the wall. Bob Iger has said that, they are willing to take the steps. He has actually publicly said that the linear TV business is no longer core to Disney. And if you just kind of look at the Disney profitability profile for 2023, out of the $13 billion that they will generate in profits this year, 75% of that is going to come from parks. So they really know where they need to kind of focus. It has to be on the parks business and getting that to even higher profitability. And it has to be, reducing losses in the streaming business, as well as kind of keeping, the linear TV business in cruise control, because the streaming business will lose close to about $3 billion this year.
Today, it seems like stock investors are getting the message, Geetha. We are seeing a 0.9% pop in the Disney shares ahead of the open. It does seem to be like that is the narrative that's coming out of this, right? Especially not giving subscribers for Disney Plus, which is a successful platform, but not necessarily emphasizing growth. And then the news about ABC. Does this mean they're not going to be investing in content, that they're hoping to save money on that front?
They definitely, I mean, that's a great point, Lisa, and they definitely are looking to save money on content. So they had initially projected about $31 billion in content costs for 2023. They've actually taken that down to $27 billion. So there's already been some, reduction on that front. Of course, that is largely in part due to the Hollywood, the dual strikes. But even going forward, I think they are going to take a really, really disciplined approach. I mean, Bob Iger has openly said that, they're not going to be greenlighting projects left, right, and center, whether it's for the film business, whether it's for the TV business. So they're definitely taking a hard look. And remember, they haven't really performed all that well on the content front as well, especially you brought up Elemental. That's a great point. I mean, we've seen a string of misfires from the Disney studio. I mean, this is one of the one of the best performing studios in the history of films. And so it's kind of been a little bit of a disappointment, but I think he is kind of really looking to revamp all of the content franchises right now.
At the same time, ESPN, long considered a contender for a sale by Disney, at a time when it was at the heart of a dispute with cable over the past couple of days. Is that still for sale? Is that still the rumor out there, or is there going to really focus on expanding and fortifying this, because sports really are the heartbeat of all of our media content?
I absolutely agree. I actually think it's the latter, that they will look to keep the ESPN network. What they're trying to get rid of is the rest of the linear network portfolio. They do realize that they have a lot of opportunity with ESPN. They're already paying about $9 billion every year in sports content costs. There's a huge advertising business there. There's a huge affiliate business, and I think there is a lot of potential. So I think they will look to keep ESPN, dispose off the rest.
Yeah, but the heart of the matter, as you led with, Geeta, and you're expert on this, is everybody needs to be Netflix. So Disney Plus picks up the Australian animation Bluey, and it's Bluey Healer and his sister Bingo Healer, and that's all great. Can Bluey from Australia deliver for Iger 21% EBITDA margins?
It actually can. It is going to take a little bit of time. What Netflix has achieved has been over a period of, 10, 12, 13 years. Remember, just a few years ago, we were criticizing them for burning about $3.5–4 billion in cash. So it's taken a while. So, yes, they have kind of set the template, and Disney needs to take a page out of the Netflix playbook. So it knows exactly what it needs to hit. And I think they will. By fiscal 2025, 2026, we are going to see this business generate fairly good margins and ultimately get to that 20–25% margins. I think it's absolutely achievable, but of course a lot needs to be done before we can hit those targets.
Geeta, let me share some of my emails with you. Hi Jonathan, the price of Hulu, no ads plus live TV, Disney Plus, no ads, and ESPN Plus with ads will increase on October 12, 23 to $89.99. TK, $89.99.
Wow.
A month?
YouTube is
$99.99
a month.
$90, I believe, is what we call that.
Yep.
That's like a barrel of oil.
$89.99.
You can get a barrel of oil in Bramo's living room.
That's where we're at.
$1,000 a year, more than that.
That is where we're at.
Bramo does the math. It's ridiculous. It's ridiculous.
Geeta, can they put up prices anymore?
I mean, it's going to be tough, but actually the recent deal that they did with Charter suggests that they are now willing to kind of rebundle all these services. I think in many ways that was kind of a landmark deal. Where we are coming, I know it sounds almost silly and ironic, but yes, there is going to be the great cable rebundling. Charter was the first step. I think we're going to see many more of those deals happen.
Geeta, thank you. Geeta Raghunathan there of Bloomberg Intelligence. Throw in the cost of broadband, TK, and we're back to where we were, aren't we? Maybe more.
We're so back to where we were. This is the one discussion, I've said this to Paul Sweeney, where the pros like Geeta Raghunathan, Michael Nathanson, Rich Greenfield, and the others, the confidence in their voices that they're going to succeed to get the income statement where it's supposed to be. I wish I could get the reach to get there. It's the one thing I can't get across the canyon, the Nathanson Canyon.
I'm glad you mentioned Michael Nathanson, because he was the one that said that the new model for sports and the new model for cable is the old model, which is bundling, and that is it.
So
worked.
What are you going to do with $90?
So why stop it?
What are you going to do with $90 a month? That's stunning.
I'm looking elsewhere. I mean, what are we paying for? Peacock, Paramount. Peacock has the Premier League football. Paramount has the Italian football. Then you've got Netflix. I gave up Apple Plus.
Are you popping over $300 a month?
Apple TV, not Apple Plus, but gave up Apple. It's expensive, let's put it that way.
It adds up.
If you want to watch all the sports, if you want all these different things, it adds up pretty quickly.
I went through 2 weeks ago and got rid of a bunch of them.
It's my own streaming bundle.
Yeah.
It's your used car.
My streaming bundle
That's what it costs.
is a mess. Barry Knapp is not a mess. He's from Ironsides. He joins us next here in New York. Looking forward to that conversation. Equity is just about unchanged on the S&P from New York. Good morning.
It's not that the US is roaring, it isn't, but it isn't yet falling into recession.
Can the U.S. recession be deeper than Europeans' recession in the first half of next year? That's certainly possible.
The risks for stagflation are certainly higher in the euro area than they are in the U.S.
Less hawkish policy could fuel yet more gains in the US equity market.
I'm not worried about an organic slowdown in the US economy. There's no sign of demand falling off a cliff.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, across America, and it is in America with an auto strike. The president will speak, and John, the backdrop, suddenly $94 a barrel oil.
The words of UAW, we will strike all three of the big three all at once. TK muted price action for the big three in the pre-market this morning, and a limited walkout across three plants. The amount of workers, TK, 12,700 people. But to your point, the president will address the nation, Detroit, and the auto workers a little bit later today. What does he say when he also says, leading into all of this, that he is the most pro-union president this country has ever seen?
His downside, and I'm sure Gene Sperling, among others, is advising him, is not to go back to the mythology of Flint, Michigan, Buick City, 80,000, 30,000, 40,000 employees. As you say, this is a contained labor action, but it could go larger.
And it's not just this industry, it's the airlines as well. And we're questioning the viability and sustainability, Tom, of some of these companies if these labour unions get what they want. What happens to Detroit's big three? How sustainable is that industry in America with the kind of labour contracts that UAW would like Ford, GM and Stellantis to sign?
And that goes back to what we witnessed yesterday in the chaos of the ECB and all, which is suddenly we're having these discussions amid a real yield, a more normal yield environment. That at least it goes back to the 90s. I mean, it is a different bond market now than 5 years ago, 6 years ago.
This conversation highlights how confusing this economic moment is, because you're seeing the crosswinds of both technological advancements, changes with deglobalization and reshoring, coming to a more inflationary moment, but a decelerating economy. How do you put those things together and get any kind of conviction whatsoever? Yes, yields are higher now. You have some people, Bob Michael over at JP Morgan Asset Management, saying it's a buy, go in, all in, they're going to come down. And you got a lot of other people, including BlackRock, saying not so fast.
I haven't talked to Amory Horton or Joe Matthew about this morning, but John, is the easy path for the president to do a photo op at the White House next week and gather together everyone, you know, to put Barr at one end of the room and the head of Ford Motor at the other end of the room, like they had Musk and Zuckerberg
split. I think boilerplate, that makes a lot of sense. Yeah. Sit on the fence, bring the same sides together, be the guy that unites everybody and tries to make everybody happy. Couldn't agree more. But has he painted himself into a bit of a corner? Can he play both sides? Can you be the most pro-union president ever and sit on the fence and try and strike a deal that pleases everyone?
You mentioned this late in the last hour. Is the floor, somebody had a great quote on this yesterday, I stole, is the floor of the union, even in these three states, these three localities, Bronco, Colorado, and Wrangler, is it a red or a blue floor? That's really what the president's speech is today.
There's still a battle for just that, Tom. You mentioned energy at the epicenter of absolutely everything we're talking about. The transition away from fossil fuels to EV, how much that's going to cost. Energy at the epicenter of retail sales and PPI yesterday. Energy at the epicenter of the upgrade to the inflation outlook out of the ECB. Energy at the epicenter, Lisa, of the downgrade to the outlook from Delta, from American, from Spirit Airlines this week. The surprise of the last month is crude back in the 90s.
Yeah, what we just heard from Sarah Hunt was that maybe it's even too fast best for even her oil investments, her energy investments, because it creates demand destruction. What this shows is which economy, which companies are strong enough at a time of waning demand in certain of the hottest industries, which are strong enough to sustain their growth, even in the face of the headwind of much higher crude prices.
Brent crude 93 and 95. Your equity market more broadly on the S&P 500, just about positive by 0.05%. TK WTI $90.50 this morning.
Oh, the WTI price is there, and good morning. Javier Blas over in Europe. Look for his article. I'll get it out on Twitter here as he says the Saudis work out off Saudi Arab Light to $100 a barrel. Let's start strong in this hour. Barry Knapp joins us, Managing Partner, Director of Research, Ironsides Macroeconomics. He drove a VW Rabbit years ago, 3 OPEC things ago, whatever it was. What does the overall stock market do with a jumble, not so much of a labor strike, but with a jumble in reality of $94 oil?
Yeah, the oil situation is fascinating. One of the things I wrote about last week that I think some have started to explore a little bit but haven't really thought all the way through is that for 5 decades, the correlation of the price of oil with the dollar was negative. The dollar was the single biggest marginal contributor to our current account deficit. It's what originally pushed us off the gold standard. If you think about decades when the dollar was decidedly weak, the 70s and the O's, it was largely a consequence of running these huge energy deficits. Shale flipped those relationships completely on its head, and the dollar now is a petrocurrency, right? And I've described it as such. So that in and of itself has big impacts on financial conditions in the U.S. and in Europe. Where I'm going specifically with that is as the dollar, as oil goes up and the dollar goes up as a consequence, it actually, because we still run massive goods deficits, you get a big offset in import prices. We're going to see that number this morning. So that actually tightens financial conditions, the increase of the dollar as it goes up. Additionally, because Asia is so vulnerable, China and Japan are so vulnerable to higher oil prices now, it actually makes them better sellers of treasuries and puts pressure on the back end of our treasury market. Again, a tightening of financial conditions. But the opposite is true in Europe, right? They run current account surpluses. They're short oil. So financial conditions loosen as the price of crude goes up, meaning there's more chance for energy price pass through. It's a more intractable problem for them. But for the U.S., a higher price of oil is no reason for the Fed to respond, tighten policy as a consequence. They're going to get big offsets. So this change in the correlation of oil is a very big deal, I think, for these flows in global relationships.
Give me the FX call then. Parity on the euro? Is that what the call is?
Yeah, essentially. And, as I met with clients this week, being back in New York, the one thing that really scares people is, back end of the Treasury market releasing. I had a target that we would go to 4.25%, 4.5% or so on 10s, 2% on reals. This is roughly where I think they should be given the Fed's holdings, right? And I think we'd be 100 basis points higher if the Fed didn't own a third of the Treasury market, mortgage market, and agency MBS market, roughly where we were pre-global financial crisis. But given their holdings, I think we're in the right or the range of fair value. But people are concerned, and I don't think it'll be yield curve control and the Japanese suddenly going big bang and saying, yeah, we're done with all this, we'll raise rates. The bigger concern would be that things get unruly in China. They let the RMB go to 8. They wind up being significant sellers of treasuries. And next thing you know, we have 10s at 4 3/4 or so. So that's
30s. You give me the FX call. We're rocking now. Give me another one. 440s on 30s right now. What are you thinking about?
Yeah, I think they're in the range of fair value and they ought to stabilize. I do think the growth outlook's likely to deteriorate. So I'm somewhat sympathetic to Michael's view, Bob Michael, that is. It's not going, I don't think they have any chance, 10s, that is going back to 3, but I could see them rallying to 3 3/4. But then we have this, oil currency pressure on Asia influence that does create serious downside risk in rates. So that would be, listen, I think the S&P is going to 4,800 by the end of the year. I think that we're going to have some weakening in the growth outlook, but the Fed ending and starting to really price in cuts next year. It's in the Fed funds curve, but it's not in things like the spread of mortgages to treasuries. So there's room for further rally through the end of the year. But the risk to my call is that the back end of the treasury market has an impulsive move another 25 to 50 basis points higher.
I want to build on that idea of parity between the dollar and the euro. What does that mean for risk appetite more broadly? I mean, you do see the S&P going to 4,800, but this comes at a time of rising long-term yields and a souring European backdrop. Is that good for risk?
You know, I think the real risk to risk, right? The real risk-off episode comes with weakness in Asian currencies, not so much the euro. The euro dollar cross is so big, even if it, if it went straight to parity next week, that would be something else. But the probability of having that big an impulsive move in dollar euro, I think, is fairly low. So if it drifts there to parity by the end of the year, I don't think that's a risk-off sort of a move. I think RMB going to 8 is a risk-off move.
And you mentioned if China sells all the rest of its treasuries, you could see yields rise up further, regardless of the reason of why. If we do get a material shift higher in longer-term yields, divorced from any Fed policy, what does that do in terms of really creating a feedback loop at a time where 10 years ago everyone was saying that the market was so distorted from zero rates? Are we going to finally see that transmission mechanism?
Well, we're headed down that track anyway, Lisa. I think where you're going with this, and certainly where my brain went as you were asking the question, was I've been describing the macroeconomic situation as an unstable equilibrium, right? So if you just think about this in terms of the large non-financial corporate sector, which has largely termed out its debt, look at the duration of the investment grade credit index. The household sector, again, has largely turned out their debt. The MBS duration has never been longer, right? So we know the effective mortgage rate is 3.30 or something. So most of the household sector is, immunized from higher rates for a time. The large non-financial corporate sector is, but the banking system surely is not. The small business sector surely is not. The highly leveraged sector, duration on the high yield index is falling. We've got a tremendous amount of commercial real estate loans to roll in 24 and 25. It's often said that the yield curve can signal a recession or cause one. We've only had this deeply of an inverted yield curve 3 times in our history: October of 73, Dece of 79, and Dece of 80. This is an existential threat to small banks. And you can, you look at bank holdings, the weekly Fed HA data, you see holdings of treasuries plunging. This is sell what you can, not what you have to. I remember it distinctly because, of course, 15 years ago today was the death of Lehman Brothers, where I had worked for 19 years at that time, right? So
I can't believe it's been that long, Barry.
It's amazing.
Isn't it nice?
Right? It just occurred to me. I was coming on the 15th anniversary.
Barry, this is one of those conversations I'm going to go home and re-listen to a little bit later. It's fantastic to see you. Barry Knapp, thank you, sir, of Ironside Macroeconomics. If you are just tuning in, welcome to the programme. The S&P 500 here, positive by 0.1%. Lauren Goodwin of New York Life Investments joining us in about 20 minutes. And right on cue, Barry, you mentioned the effective mortgage rate. 360. We've got the chart as well. It's an amazing chart. Right. TK, down, 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 and then just inching just a little bit higher, back to about 360. So this is where the effective rate is. We know where mortgage rates are, in and around 7%. If you go and get one today, this is basically the average rate on the outstanding pool of mortgages at the moment, Tom.
Yeah. And what's very important here, and it's hugely, hugely nonlinear. It gets going, and then the ramifications, if it continues to move higher, to the tension Barry set out farther out the curve, it's not linear. There's gonna be some real pain if we get the breakout.
Only
higher.
about a tenth of outstanding mortgages at origination are paying above 6 or something like that, and this is going to take a long time to see that 360 shift higher towards the 7, if they're even at 7 in years to come.
The only way it works out is to get a substantially lower yield. All of a sudden, yields come in and everybody refis at 4% or something.
Barry, this was great.
June.
It's good to see you, mate.
Next year.
As
All
always.
right.
Henry Trays of Veda Partners is coming up next. There is a strike in Detroit for the Big Three, and we're waiting to hear from the President of the United States. From New York City, this is Bloomberg.
From day one, we told these companies, we don't expect them to delay and drag things out, and that's what they chose to do. We didn't want to be here. We want a fair agreement. We want fair economic and social justice for our members. That's what this is all about. They've had a decade of record profits. When they're profitable, it's all theirs. But by God, when workers ask for their fair share, it's the end of the world.
That was UAW President Shawn Fain joining the picket line in Michigan. There is a strike. We will strike all three of the big three at once for the first time in our history. That's rocking Detroit this morning. It's not rocking this market. Equity futures on the S&P just about unchanged on the S&P 500. Yields a little bit higher, up by 3 basis points, 432 on a 10-year. And in the pre-market, if you look at the big three out of Detroit, Stellantis, GM and Ford, the muted price action, Tom, still pretty muted through most of this morning.
It should be. It's a surgical strike. Bramo nailed this yesterday at 10 p.m. It would be something different, and it is. Review it, John. It's 3 different states, 3 different models. It involves what, 12,000 employees?
12,700 across 3 plants.
It's like a mini strike compared to the Teamsters, UPS. This is a nothing burger.
Important piece of this, Tom, is UAW members will get $500 a week from the union in strike pay. There's only so much money. So if you want this to last long and hit hard, you have to do this strategically. So you start with 3 plants, 12,700 workers. If you want to up the disruption, then you start thinking about the F-150s.
Do we have a when on that? In all of our reading, do we have, when do they go to F-150?
No, not really. And I don't think they want us to have a reading on it.
Right.
It's the unpredictable side of this from UAW's side that gives them a little bit more leverage in talks.
How's the president spin this? I mean, he's going to have a script, obviously. You know he's going to go off script.
Perfect statement. Perfect boilerplate for any president to issue to bring both sides together. The problem is, Bramo, as you know, once you've gone around saying you're the most pro-union president in the history of this country, can you get away with just saying what any traditional president might say about a dispute like this one?
Maybe that's the reason why we haven't heard anything yet. Because we do think that there's going to be some kind of statement, but it hasn't been established when. Is it because they don't know yet? Is it because they're still writing that statement?
Without a doubt, they don't know.
I think he's going to fall back on the mythology.
They should know.
They should know.
Because they should have had a range of options lined up for whatever the outcome of these talks were going to be. I don't think we've got a time. We don't have an understanding of what either.
My bet is he's going to fall back on the mythology of his youth and of Scranton, Pennsylvania. Part of that mythology, of course, is going back to the 30s, as Anne-Marie Horton mentioned earlier. And what we know for certain is the UAW has a heritage, has a history. And so on Decatur Street in New Orleans, John, does Aunt Sally's pecan pralines.
Nice.
Back to the 1930s.
These look good.
Bearing gifts this morning from New Orleans on television. It is Aunt Sally's pralines. They're for Bramo. And here you go, Lisa. And,
just to be clear, we're not saying Sally. We're saying Sally.
No, it's Sally's. It's my accent.
Was that a southern accent?
No, I don't have a southern accent.
Do you want to do the calorie count?
On radio, it's like a calorie count on radio. That's all you need to know.
What's your guess?
Henrietta Trace joins us here, encyclopedic on Washington. And very importantly, Henrietta, in this moment, this is a president who's got to come up with a new statement for a president on labor unrest. What's it sound like?
If you're interested.
I think you're exactly right, falling back on that Scranton narrative and speaking to labor unions the way that this administration has their entire term. We've done this before. They have a huge success rate, so I think there's a lot of maybe not surprise in D.C., but it's a different circumstance now that there's actually striking happening. And I assume it's DEFCON 1 up there, and they're all going to work to resolve this.
What do you think his response is going to be? Let's dig into this. He already cut off the railroad workers from striking. He can't do that with this. Mm-hmm. Even though they did that, they still went around saying they were the most pro-union administration in the history of all administrations in the United States of America. I'm not sure how you can be so pro-union without giving people the right to strike. Now they're on strike. Shouldn't you be supporting them?
And it's interesting to watch because there's a number of Democratic lawmakers in the Senate and the House who are going to join the strike, right? So you have this situation where the White House is obviously going to try to get the strike to conclude, but there's a host of Democrats who are actually going to strike with them. So it's a bit of a two-sided videotape right there.
What about the Republicans? Where should they be coming in, or where are they coming in to try to capitalize on something that's fraught on both sides? Because this is no longer a one-party kind of issue with unions.
It's really not. And I think that Democrats really focus on this because President Trump, when he was in office, was so successful at taking so much of the union vote away from the Democratic Party. And that's a material shift that Democrats have to worry about for the future. So when you see, for example, Trump comment on this, it's really deflective and moving away to electric vehicles. So we're anti-electric vehicles, which is, of course, a big component of this, but we've just subsidized the entire electric vehicle industry substantially, whether through the CHIPS Act or through the IRA. Treasury's working on all those electric vehicle tax credits right now and more. That's what is at the heart of this debate, because they need less workers for those vehicles.
Does it look less likely that if the auto manufacturers did run into trouble on the heels of some of the labor pushback and their financial situation did weaken substantially, that any kind of future bailout is off the table the way that it was back in the day?
Oh, my gosh. I was in the Senate when we did the auto bailouts. I don't want to hear that again. I mean, not to bring it in, but Mitt Romney is retiring, so maybe we... That's terrible. But no, I don't think that there would be another bailout. I don't think that that is something that this administration or America is prepared for at this point. We passed a lot of spending bills. I don't see a sector-specific bailout occurring anytime soon.
2020, union vote, Biden 57%, Trump 40%. At the margin, critically, from 4 years before, Biden did way better than Hillary Clinton. Mm-hmm. Where are we now? Drag it forward 3.5 years. Does Biden still have the union vote majority?
I think that when you look at not necessarily the union vote, but all voting turnout, there are other issues that are bigger than just union issues. And we have kept all those tariffs on, which labor unions are in some cases supportive of. The administration has gone a long way towards reshoring those union votes. So I think they stay. But Trump is, got a stranglehold on his party, and so none of those voters are leaving. So I wouldn't be surprised if it was exactly the same.
I'm not sure how we can have a viable auto industry in Europe or in the United States without monster tariffs protecting this industry. I'm not sure how it can be viable, given what's happening in China at the moment, the opportunity that they have to produce vehicles at much lower prices, much lower cost than the Europeans. The Europeans are already complaining about that. Isn't that the direction we're travelling in here? That Europe's about to smack tariffs even higher and basically say the same thing as America. You want to sell here, produce here?
Absolutely. I mean, tariffs, state subsidization, domestic subsidization, friendshoring, all of that is very much in the cards. And I think for the foreseeable future under this administration or in the case that Trump wins.
Have we thought this through about what this EV transition is actually going to look like and how costly it could be for governments, Europe, China, the United States?
I don't think so. And you're seeing that in a lot of the delays of these regulations coming out on clean energy, not necessarily just on electric vehicles, but the solar, the hydrogen, all of those alternative clean energy components are requiring tremendous amounts of manpower at Treasury. And one of the things I hear most frequently is we just don't have the experts to finalize these regs. We're working on it. We know that Commerce Secretary Raimondo is staffing up Commerce with 150, 200 new people to address how to roll this money out, where it should go, how slowly to phase in these changes, how tariff rates should work in conjunction, whether with the EU or with Mexico. Those clean steel tariffs, what are those really about? So they're all connected, but I think it's slow going, and industry is very keen on getting the details.
We're going to be talking about this for a while, no doubt about it. Henrietta, thank you. It's great to see you. Henrietta Trace there, Vader Partners, and thank you for the treats as well. Appreciate that too. Coming up in the next hour on Bloomberg TV, Mohammed Al-Aaron of Queen's College, Cambridge, right here in New York City. We'll be catching up with Mandy Zhu and Jim Bianco of Bianco Research. A couple of weeks ago, Jim Bianco said it. He said energy will be at the epicenter of everything we talk about. That was the last time we spoke with him. A couple of weeks later, energy is at the epicenter of everything we're talking about. Equity futures on the S&P 500 absolutely unchanged. UAW shaking up Detroit but not shaking up this market. More on that going into the opening bell from New York. This is Bloomberg.
Bloomberg surveillance. There is a strike in America. There are some touches to the past. We've got images right now here at Bloomberg on radio. It is the cold blue sky of outside Detroit, Michigan. And this is images of the Michigan assembly plant, what we used to call Michigan Truck. This is where they build the Broncos, and this is part, Lisa Abramowitz, of the fabric the president will talk about. There's all this modern new mumbo jumbo. You know what? Joe Biden wants to go back to Michigan Truck.
Well, and this is the reason why it's such a fraught moment as they do protest. This just coming out from Citi, from Andrew Holland Horst and Veronica Clark, saying that a UAW strike would affect the auto production, the GDP. Auto production accounts for 3% of GDP, with about 2/3 of that at the big three in Detroit.
Perfect time. We're going to go to Lauren Goodwin here, but first, Michael McKee drops by today. Do you have any economic data at 8:30?
We have a little bit of economic data. Import prices are out, and they are up for the month of August by 0.5 percentage point, but take away petroleum, and they're flat. So the oil story continues into day two. Empire Manufacturing, just quickly, comes up to 1.9 from -19. It's a tertiary indicator, but it's out there.
Yeah, the tertiary indicator. Michael McKee, with a lot of experience about labor. When the president speaks to the nation today, it's not 1958 Eisenhower and Reuther of Detroit. This is a different story today.
Well, it's a different story. The automakers are much smaller part of the economy, the big three automakers in particular, because so many of the foreign car makers have located plants here, and union membership is way down. But I went back and looked at 1998 GM strike. It's very similar to this in that they struck a couple of plants, but those plants shut down GM production around the country because they made parts, and it was about as many people as if the entire UAW goes out this time. About 180,000 people went on strike at that point, and there really wasn't much of an impact. In the third quarter of 1998, industrial production of cars fell, of course, and in the third quarter, we saw the number of auto workers on payrolls fall, but then they came right back up again, and the cars were sold, and GDP was unchanged.
Mary Barra with David Weston at 10 a.m. this morning. She is the engineer from what I will always call the General Motors Institute. It's not the Kettering, whatever it is, but she actually knows what to do with a wrench in her hand. She was weaned on the manufacturing multiple. So you, me, Diane Swank, and the rest are at the National Association for Business Economics in Washington. Does that room full of economists believe in the manufacturing multiple in America?
Oh, sure. And as manufacturing grows, it adds more value to the economy than a lot of other parts of the economy these days, because so much of what we do is service industry oriented, and so much of that is also intellectual property oriented. And the manufacturing people are actually making something and
that's a mythology, Lisa, the president's going to capture.
That's the whole thing about this strike is obviously the auto workers want a piece of the profits that the automakers have made since they gave up so much in 2008 when they went into bankruptcy. But it's also about who's going to make the products of the future. Is it going to be the guy who grew up in Lansing and knows how to do something with a wrench, or is it going to be the guy who can program the computer to make the car?
The Fed is also watching this very closely at a time where we're thinking about wage growth. We're thinking about what this means for inflation. How much does it signal that labor inflation is accelerating or becoming entrenched? And how much does this signal a certain desperation at the end of this whole cycle?
Well, it may be more desperation at the end of the cycle. Obviously, we have seen unions get some very large pay settlements. And we did see a knock-on effect in the CPI with airfares going up, which people assume is in part because the pilots got big contracts. But then it's a one-time bump. And the question is, does that have a long-term impact on inflation? Probably not. What you don't want to see is that the automakers then come back and raise their prices significantly, and then the auto workers have to ask for more money, and you get into the wage price spiral of the 1970s. But right now, the Fed isn't thinking it's going to be a major impact on the economy longer term.
Michael McKee, thank you so much. Just terrific. Yesterday as well, in the blur that we saw of economic data yesterday. Out on the left coast, there's an economics program which is not talked about enough. It is the University of Southern California, USC. It is a spectacular program. And one of their ace students of the recent years is Lauren Goodwin. She holds a shingle out at New York Life Investments and joins us this morning. There's no love for West Coast economics because it's all sunshine and roses and happy, and we're in, the sun of California and all that. And yet you're the gloomiest rain cloud to come in from USC going. You believe in a hard landing. How on USC? Where's our hard landing?
Look, the economy never reacts the exact same way in every cycle, but it does tend to rhyme. And when the Fed raises interest rates, you tend to see interest rate sensitive and liquidity sensitive sectors navigate first, then manufacturing, services, and then the labor market. That's exactly the way that the economic dominoes have toppled this time around. The fact that we're sitting, waiting for the consumer and the labor market as those last dominoes to topple doesn't tell me anything about where the economy is going to be in the future. That's actually very typical.
You're at New York Life. It's old, quiet money, all wrapped around this strange thing called an actuarial assumption. Now that rates are back to my ute, not your ute, and we've got an actual real rate, the 10-year right now, 1.98%, up a solid 4 beeps this morning. In the new interest rate world, do we have to lower our expected return because our economics is a new economics?
I think it's an important question, and the answer is yes in some areas and no in others. With forward-looking equity market returns, especially at valuations where we see them now and where we see the economy expect it going ahead, I do think it's challenging to expect a 8% return over the next year.
I was looking for 20. Come on.
Well, we've had it over the past couple of years, right? That's part of the challenge for investors. But we do see stronger yield and some structural changes in the economy as a result of pandemic-era programs as being really constructive for portfolio construction and for the yield that investors can harvest in this environment.
Basically, you're actually getting yield for the first time in a long time. And that's been the story. Bonds are back, and this whole question of how much can you capitalize on that. I love this idea from you. Cash is not a riskless asset, sort of the missed opportunity in long duration at this moment as a risk that people aren't counting on. Why is it a screaming buy for you right now in 10-year and 30-year treasuries at a time where there's a big debate about whether those yields can go higher?
Interest rates can go up for a lot of reasons, and why they go up is just as important as how much they go up. And right now, or in the last couple of months, the run-up in interest rates, long rates in particular, has been a function of supply and demand factors, the term premium, and not so much because inflation expectations have changed meaningfully or that the expected path of the federal funds rate has changed meaningfully. And when you have changes in the term premium, that suggests that rates are likely to be more volatile moving forward. And so actually, I'm not as big of a fan of meaningfully adding duration of portfolio, though I love what we heard from Mr. Gallo earlier around taking from cash, adding to bonds. But in terms of aggregate duration exposure, we really like a neutral position with short duration in corporate credit, especially high yield, where I see some really interesting structural changes in quality, and adding longer duration in the municipal curve, actually, where curve inversion is less of a challenge and we see it better rewarded.
I'm wrapping my head around what a hard landing means. If a hard landing means what it used to mean, which is there's going to be corporate defaults, there's going to be a lot of distress, there are going to be layoffs. Hard to see why anyone would get excited about corporate credit, about equities, about even municipal areas that are going to get challenged with tax revenues.
Well, it goes back to your first point, which is that there is yield that helps compensate for some of the risk. But more importantly, in corporate credit, especially publicly traded and probably exclusively publicly traded corporate credit, government programs during the pandemic have helped companies to shore up their balance sheets, to extend their maturity walls in a way that's very different from previous economic cycles. What's not different is that spreads are likely to widen. I fully expect that. So from a price perspective, you're still taking equity-like risk in high yield. The difference is that you can harvest coupon in the meantime, and because we are not yet...
You're killing me. You're killing me. That's what they say at big insurance companies. We're harvesting coupon. It's like,
you
wheat,
go out,
or, we're harvesting.
You call the coupon.
You call the coupon.
In the
Let's
field.
harvest. Excuse me.
We might still clip them actually in the back room.
Yeah, I'm sure. Yeah, I don't think that they have
And
them.
they store them through the winter continually.
The big issue here,
interrupt.
right now, as you're talking, I'm thinking to myself, okay, this makes sense over longer term, but what a wild card oil is going to be at a time where people aren't really clear on exactly what the drivers are. Is it a bullish signal of demand, or is it a bearish signal of supply manipulation leading to higher prices? How much do increasing oil prices throw off kilter some of your investment theses?
I think that higher oil prices matter a lot. And I think it's both, to answer your question, a bullish signal of the cyclicality that we've seen in the last couple of months, but a bearish signal because higher energy prices, although many would say they're headline inflation, not core inflation, they matter less for the Fed. That's just not true for the real economy. We all pay for oil, whether we go to the pump or whether it works its way through to core prices, through PPI, which we saw yesterday, and through the way that they work their way into the real economy. And so higher energy prices are a major risk. I think it's part of why we saw a rate hike from the ECB yesterday. I think the Fed is going to be paying very close attention to the path of energy prices ahead.
I want to get back to the core New York life ability, which is to look out long term. The IMF announcement of a 5-year 2028 global growth slowdown. What's your run rate on real GDP in America out to 2028? Model that out. Is it sub 3%? Dare I say, is it a potential GDP sub 2%? What's your vision on that?
I expect that we actually may see higher than 2% GDP growth on a 5-year time horizon. And that has everything to do with the investment that's going to be required both from the public and the private sector with respect to the green energy transition and with respect to the digital transformation.
See how she ends with a USC optimism? See that, all this hard landing stuff baloney. Dyed-Wool USC. It's a great program. It drives me nuts how Hollenhorst, the Citigroup, was at UCLA. And the two programs.
We won't hold that against him, though.
You won't. Thank you. We'll leave it at that. Lauren Goodwin going after Ellen Hollenhorst this morning. She is with New York Life Investments. Lisa, my head was spinning yesterday, and I don't think it's any spinning less today. What's going on?
It's just there are a lot of crosswinds and trying to really put them together and understand. And I feel like the UAW strikes really highlight just what a transition moment we're in. Because on one hand, you have technological advances changing the conversation, changing the policy, and you have workers with renewed power and renewed cloud to say, wait a second, we have not kept up. Where is our profits at a time where you guys just are coming off big profits? And oh yeah, to boot, maybe some of that demand is cooling down. You put these things together, it is a confusing and tumultuous moment.
I like the phrase confusing there because it's certainly the toxic brew that we're in right now. Standard & Poor's 500 down 0.1%. Looking, we got to go to ARM. I mean, Farrell got his usual 8,000 shares with the contacts he's got on the street.
Oh, yeah.
And I got to pop 51 to 61. And then, Amy in the control room said it got a little soggy here in the last hour as well.
Yeah, Masayoshi Son was looking for a win, and it still remains to be seen whether he'll get it. I mean, that to me is the biggest takeaway, is that this was a manufactured kind of IPO with a very small subset of the shares being sold, and they were underpriced based on market valuation. They came in at 51. Masayoshi Son said, I don't want to go to $52 a share. If he had gone to $52 a share, $1, it would have been $100 million more in valuation that they could have booked.
With the economics, the finance, the investment, the international relations we do, and of course with the president speaking later today, we still need an announcement on that. Bara with David Weston here in the 10 o'clock hour. Well, guess what? We're going to delve into ARM and cloud and the rest. Mary Barr is going to do this. I know they're doing AI.
She's going to delve into ARM with us. Mary Barr, come talk about ARM.
But she's thinking about it. That's the problem. Joe Biden's going to go out and talk to the people outside Michigan truck, and Mary Barr is worried about AI.
Well, that's like, exactly. How do you adapt to new technologies with an infrastructure tethered to the romance of an old economy? How do you do that?
We're going to have to see. It's 8:43 Friday. We're charged. Stay with us. Mandeep Singh next.
We also have a very unique business model that gives us the ability to have a very, very good vision in the future in terms of when people use our products. So relative to our confidence in the outlook, we have a very, very high confidence that the growth rate that we have talked about will be sustained.
That was Renee Haas, ARM CEO. This is not Instacart. This is not one of the companies that have more speculative business models. This is a tried and true, at the heart of some of the transitions type of company. And it got a good recognition, at least in the NASDAQ trading, the first day of trading yesterday, perhaps less so today. We'll get to that in a second. Tom, I do want to just go over some of what we have been talking about through some of the movement that we've seen in the stocks. We've been talking all morning about the UAW strikes, this question around what kind of damage that would do to the big three in Detroit. We can see that the share price of GM, Ford, and Stellantis are not really moved that much. I mean, you could see it coming back even from some of the lows earlier. General Motors shares down 0.4%. Ford possibly being punished the most, down 1.1%, and Stellantis up 0.5%. But I'm not sure what to read into any of this, whether this is a union that wants to inflict less damage by doing a surgical strike, or whether they're hunkering down for the long haul.
I totally agree with you. And what this is about, I think the team did a great job overnight. We knew this was coming to an extent. And I think the voices that we've had are away from hysteria, OMG, a strike. And the leadership of the president will set the tone for both parties. And we'll see if we go from the focused tension of these three small factories, Bronco, Colorado, and Wrangler, out to something bigger. We don't know.
We also don't understand what the anger level is right now at a time of transition where there is an existential angst about what kind of future there is for some of these jobs. I do think that is a big piece of what's underpinning this. I do want to just bring you a couple of other names that we're looking at and talking about today. Disney, we've been talking about today in terms of whether it is going to be holding talks to sell ABC to Nexstar or possibly somebody else. That was reporting from Bloomberg. We also were talking about how they don't want to give any estimates for Disney Plus, basically hunkering down on the parks business, the cruise line business, the experiences business. Tesla shares maybe getting a little bit of a pop on the heels of turmoil elsewhere. And ARM, we were really wanting to focus on ARM with the IPO that came out yesterday. 25% pop, seeming to gain it today, Tom.
ARM Holdings is a holding company. They're holding a company for technology. To brief us here, Mandeep Singh, Senior Technology Analyst. Mandeep, every single grid I look at of fancy ballyhooed IPOs, out a year, out 2 years, I'm going to be direct. It's painful. Okay, we got the obligatory pop. Everybody got the merch. Everybody went to the lunch. That's great. What are you going to listen for in the first conference call from the Chief Financial Officer of ARM?
Yeah, look, I think what they said at the roadshow is they are in 30 billion chips a year. That's a big number, but what they make as royalty is 8 cents. Now, that's why the revenue run rate is close to 3 billion. They talked about doing their chip design. They've talked about raising royalties. To me, it's still a volume-driven business. As long as that 30 billion is growing, it translates into revenue, but I can't see them expanding into chip design. That's when you're competing with your customers. You're competing with NVIDIA. You're competing with all the fabulous guys, and I don't see that happening.
Mere mortals like me have enjoyed losing money within the volatility of the SOX index. Okay, these guys are in. It's like a Texas Instrument analog back to the back. I'm going to get a lot of hate mail on what I just said, but stay with me here. What you do in an IPO is you warble gaily about revenue. Baloney. Go down the income statement, and can you model out an EBITDA line for ARM?
You can. And look, it's a 95% gross margin business. Yes, they have to spend a lot on R&D to develop that new core, which everyone would want. And that is R&D intensive. Their R&D intensity is close to 40-45%. But this business can generate free cash flow. And nobody doubts that. The question is, how big can the top line get? And that's where, if you look at the last 10-year CAGR, it's been 10%. Whereas when you see NVIDIA, which is selling 100 million chips a year, but at a revenue run rate of over 50 billion in their data center business. So that just goes to show ARM doesn't have the pricing power.
Was this actually an IPO, or was this a fundraising effort?
Well, this, I think, was an attempt to really go to the public market because this is a very important company. And the fact that they don't have the pricing power, they're trying to garner that attention that, look, we are a very important part of all these mega trends that are playing out, whether it's AI or autonomous driving, everything is built on ARM at the core. That's the core IP block that everyone is using.
But to the conversation that we were having earlier about whether this is just an effort of Masayoshi Son to distract from some of the other bets that he and SoftBank had made, is that kind of what this was, especially because he avoided pricing this $1 richer simply because he wanted that 25% pump? He wanted all of the hype around this as a huge success.
Yeah, I mean, look, you want to generate that excitement, and this has been one of his success stories when it comes to the Vision Fund and just the investments they've made. So clearly, I think an IPO pop is good for the company overall, the sentiment. But I still think anytime you see a company trading at 20 times forward sales, you have to ask yourself, can the growth accelerate from here? And that, I think, is a question mark.
The only question off the Apple product announcement, and I guess maybe to be fair, Lisa, we wait for the Apple earnings announcement whenever that's out in the end of October, I'm guessing, is there's a single headline that comes out of China and everybody goes, oh, all the gloom's wrong. Lisa, there it is. iPhone 15 Pro Max models in China, where you can order the white one with 1 terabyte and have T-Mobile basically pay for all of it, quickly see 4 to 5 week delays. I'm shocked. I'm just shocked.
Yeah, they went on pre-order this morning, and all of the hand wringing around whether people aren't going to buy in China. Well, Apple shares are up about 0.75% on this news as people realize maybe the gloom and doom around China and the demand for iPhones is
Lucy
overstated.
And Charlie Brown in the football. I mean, when are we going to learn, Mandeep?
Yeah, look, I think when it comes to upgrade cycles, I mean, Apple still has a very strong hold. The lock-in is immense.
Can I go geek on this? Can we do Finish a Nerd Friday?
Please, let's go.
They've got a 3-nanometer chip.
Yes.
The camera's got some new razzle-dazzle. It's titanium, blah, blah, blah. It's got this, it's got that. I mean, like, does Tim Cook know this headline's going to come out 3 days ago?
Well, I think they are very confident in their product cycle, and that's why even if people said on the surface it didn't look like a big upgrade, it turns out
precisely
it is.
Well, hold on a second.
Yeah.
But there's a larger question here, which is, are we getting over our skis in concerns about geopolitical tensions affecting tech demand? That is really at the crux of this, and it goes to ARM and it goes to Apple. Is that what we're seeing today with this headline?
Well, so there is that soft China demand aspect and, the government banning iPhones. So clearly there is a revenue hit there. But the bigger question is the supply chain diversification. Can Apple do that successfully and at the same cost structure that they were doing that over the last 5-10 years?
Although I will say, Tom, that the idea of restricting iPhone use at state-owned enterprises doesn't seem to be dampening demand in China for the iPhone.
Tom Forte Davidson with us earlier in the week, neutral, $180 a share. Some guy named Ives at Wedbush,
some bull
$240
with really cool sneakers.
A share. I mean, it is a debate, but Mandeep, I've been through this like 10 times. OMG, it's a 4 to 5 week delay for the toy. I mean, we're idiots.
Well, and that's why they raised the prices of the Pro Max, because that's where you see the demand. I mean, clearly there is a market share aspect and then there is an upgrade aspect. The upgrade happens almost seamlessly at the highest end, and that's what you see with the Pro Max.
To all of our team, just thank you so much to you and Anurag Rana for speaking. These guys, I mean, they're like the nerdiest of the nerds. I mean, it's like they're huge. They actually know what's in the phone.
They're huge. That's fantastic. And I
They're
quote
like
you
huge.
next time you say that about me.
Where are we?
Grandma's the nerdiest of nerds. She's huge.
Lisa, you're our authority. You nailed it last night, 10 p.m. We're at UAW. I mean, it's just. To me, it's just going to be extraordinary.
I haven't seen it.
President.
I haven't seen a time yet. This is going to be curious to see how he dovetails, how he tries to thread this needle at a pretty fraught moment.
We're going to thread the needle here to inform you across all of Bloomberg on this strike in Detroit and down to the south as well. 3 automobiles, the Bronco, the Colorado of GM, and the Wrangler. I'm sorry, it's Jeep, not Stellantis. There they are, 3 factories. Our David Weston, with his work and his heritage of living in Detroit. David Weston in conversation with General Motors CEO Mary Barra. Look for that in the 10 o'clock hour. The Weston interview is always a different interview in this time. Not a crisis, but labor tension for the head of GM. Futures -6, Dow futures at -19. The 10-year yield 4.33%. What do you need to know? $94 a barrel Brent. Good morning.
We've yet to see the full effects of the previous tightening come through into the real economy.
We have structural imbalances here in the U.S. that no one wants to deal with in Washington.
The bigger concern would be that things get unruly in China.
I think the Fed is going to be paying very close attention to the path of energy prices ahead.
The Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From the City of London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. The only reason we're on tour is Bramo's birthday. Happy birthday, Bramo.
Thank you.
Birthday present.
Isn't it?
Well,
Happy birthday,
thank
Lisa.
you. I appreciate it.
What else are we doing on the birthday tour?
Well, I'm going to go to Camden this afternoon, and
Okay,
maybe
nice.
we'll, a Tots game, I
Are
think,
you
is
going
probably in
to
the
have
works.
hot brown water with the king?
Hot brown water.
brown
You're really
water. Hot brown
you're
water.
What's hot brown
ingratiating
water?
Hot
yourself.
brown water with the king.
What is
4
hot brown
p.m.
water?
It's a proper
It's
hot water.
tea with
Okay.
crumpets.
Okay, let's restart. Live from the City of London this morning. Good morning, good morning. Here all week for you with some fantastic guests as well. Let's start with equity futures on the S&P 500. Positive here by 0.1% on the S&P. TK, not talked about enough this morning at all. We are very, very close to cycle highs on a 10-year this morning. 434 in America.
I think it's completely underplayed the market. You're dead on. I look at the 10-year real yield just as the benchmark, buttressed right up against 2%. Anything through 2.02, 2.03 would be something new. But you're absolutely right. This is underplayed right now, and that's going to change abruptly as we go. There's a meeting on Wednesday, I believe.
There is, and there's
There
another
is.
meeting on Thursday at the Bank of England. There's another meeting
Yeah.
on Friday at the BOJ. TK, your favourite line, that phrase from the Disney movie, A Whole New World?
It's a whole new world
A whole
after
new
all.
world.
It
A whole
is.
new world. Where 21% price wage gains don't make
Yeah.
it happen, don't get it done.
For the American audience, I mean, it's stunning to land here, drop off the Gulf Stream at Heathrow and come in to a strike of junior doctors in 75 years, much like UAW, but in 75 years, you've got NHS strikes here over the shocking pay these guys make. Residents, they're making next to nothing here.
Compared to the United States.
Oh, it's amazing. The
Well, auto
difference.
workers as
Yeah.
well, Bramo. Let's go through the numbers. Starting at 40%, down to 36 at UAW. Stellantis say, OK, let's go. Let's go up through 20. And nothing. Tumbleweed. UAW does not want to play at all.
Which raises a question, what will get it done? It's unclear. If it's not 20, if it's not 21%, if it's not 22%, if it's not extra sick days, if it's not anything else, is it just the full thing or else nothing? And this does tie together with the angst that you're seeing in the bond market. Basically, people coming out and saying this is going to keep inflation present for a longer period of time.
Well, what's Mari Barra do? I thought her conversation with David Weston was really apt. She was pretty tough about it and all. Does she dial 1-800-MUSTANG and, call up Ford and say, let's go? What are we going to do? I don't sense any of that here as we begin the week.
Jim Farley, Ford, we've never seen anything like this. Dazed and confused. Lisa, we talked about the strategy coming into this ahead of the deadline. We were talking about how they might target one over the other. Traditionally, that's the playbook. Mr. Fain has not followed this playbook whatsoever.
And that was by design. That wasn't necessarily a bug. It was a feature of this entire program. It was to surprise. It was to shock and awe, to try to claw back some of the concessions that were made in the aftermath of the financial crisis and ahead of artificial intelligence and key changes technologically.
To me, so much of this, including the tension in the United Kingdom, is get it while we can, because if you lock in a disinflationary tendency, as many people suggest, you better get it while you can. Do you like my bow tie?
It's beautiful.
It's
what does
a
it
Ferrari
represent?
bow tie. Yeah, for those of you
After
on
the win over the
radio,
weekend. Nice.
It's like very Carlos Sainz,
Okay. You want to talk F1 or move on?
No, we'll move on.
Okay, good. I thought we were going to talk Formula 1 for a moment. Thank you, Ferrari, over the weekend. Let's start with the price action. Equity futures here positive by 0.1%, going into the central banking triple header this week. Federal Reserve on Wednesday. On Thursday, some Bank of England action. On Friday, the BOJ. Looking at this bond market, Bramo, I think we've got to talk about it again. 434 is so close to cycle highs, and I cannot believe waking up this morning it's hardly been talked about, with crude near new highs for 2023 alongside it.
And driven by real yields that are bumping up just a hair away from 2% at a time where people are gaming out. What does this mean longer term? Feeding into this argument, 10 a.m., and I think this is really important to watch, Saudi Energy Minister Prince Abdulaziz bin Salman is going to be speaking at the World Petroleum Congress in Calgary. I am so curious what he says about how much they're going to continue prolong their production cuts at a time where Brent crude is bumping up against $95 a barrel. Meanwhile, today, the UN General Assembly is holding its 78th annual session this week. Of note today, Vice President of China, Han Zheng, is meeting with Secretary of State Antony Blinken on the sidelines. Very curious about this, which came together quickly and quietly, especially in light of some of the tensions that have been percolating between both nations and the European leaders and China as well. And today, kicking off a week of the monthly housing data dump, 10 a.m. we get the U.S. NAHB Housing Market Index. Housing affordability is the most negative, the worst it has been in the history of this series going back to 1986 by the National Realty Association. And I'm wondering at what point you start seeing that feeding into some of this price-wage spiral. Rents are getting really expensive.
Big time.
Home prices are not affordable. How do people deal with that?
As we're in London, should we share some local knowledge?
I think so.
Rents in London up more than 17% year over year. 17.1%. Now, compare that to New York. We were talking about Manhattan rents being up something like more than 7% year over year. Bravo, 17% year on year. That is just absolutely phenomenal for all the wrong reasons.
And you wonder why people are striking. And you wonder why people are saying we got to get paid more. It is staring at them in their face when they see their rent increase, when they see their bill at the grocery store, when they see their petrol bills. See, I'm adapting.
Petrol. Do you like that? It was nice.
I was just like, you know, I'd like to be able to tip
Have we got
the
this?
waiters
Are you bringing this back to New York? It's just petrol while we're here.
Well, while we're here.
Gasoline when we get back
I
to New
think she's
York.
got a British accent going.
By the end of the week.
I'm not Madonna.
Give Bramo till
Bring
Friday.
in Jeff Ewan.
Oh, digs at Madonna.
No,
Sorry
I mean,
for that,
just,
Lisa.
no.
Jeff Ewan joins us now, Senior Market Strategist at BNY Mellon. Good morning, Jeff.
Got a British accent.
It's good to see you. Yields at 5% at the front end, pushing cycle highs on a 10-year. Dare I say it, is this the new normal? Are we getting comfortable with this?
Well, let's go back to Tom's point about real yields, okay? You can deflate via CPI, headline CPI. What if we deflate nominal yields by wage gains or potential wage gains? So then if you take the 20% or between 20 and 40% real wages, nominal wage gains, if realized, then real yields actually are very, very negative still. And then central bankers have to catch up. So there's a risk here, going back to your point about a wage price spiral that isn't going away anytime soon.
What is the x-axis on real yield? So here we are at 2%. I've done some fancy math. I get to 2.20. Maybe I'm still here at 2%. Whatever it is, there's a length of this new real yield. Where's the tension point out into next year?
So basically, you have to identify where potential GDP growth is, medium to longer term growth in the US. If that's a headline number, nominal number, 3 to 4%, then find your inflation target. Then if it's still 2%, right, then real yields, you still need to get to 2 to 3. Right.
To go nerdy on a Monday, R minus G, are we at a risk here where the interest rate becomes less than the small g, as Blanchard and Stiglitz, among others, worry about?
I'm glad you brought up Blanchard because I want to bring up another paper between him and Chair Bernanke.
Yeah,
when does this become a problem?
Such a nerd fest over on the port side of the desk.
Favorite part of the morning. In terms of wages versus price spiral, and with the oil prices going where they are right now, you get a price spiral according to that paper when labour markets are tight. Yeah. So here are the unions making the gamble or the determination in manufacturing. Labour markets are still very tight right now in the US.
Which raises a question, is this signal or noise? Because this is, yes, it is now tight. Although on the margins, you're seeing signs that you are getting some sort of labour market softening. Is this the last gasp, as John was asking, of labour market power Or is this something else that does have a stickier nature?
I'd say on a broader basis, this does feel like a last gasp if I look at things globally. But on the other hand, I'm an FX guy at the end of the day. Relative, it's all about the relative differentials. I think US labour market's still tighter compared to what we have in Europe right now. So on that note alone, probably labour has more bargaining power in the US compared to in Europe.
Does that mean dollar weakness?
I would say, a short-term, dollar strength, that's still going to be in play because that puts the Fed on a more vigilant footing, to borrow an ECB phrase. But net, I think that pretty much that is in the price right now. So let's see where we go in the medium
Very
term.
cliché of you, Jeff. Let's talk about Powell on Wednesday. On Wednesday, we get a set of projections. Yep. Most people assume that for 2023, when we look at revised growth figures, they're going up. Yep. When we look at revised inflation figures, they're going down. What does 2024 look like for you and the team?
Still 2024, it's less about are they going to hike further. It's more about how long do US rates stay where they are. And that is what the BOJ will be looking at. And what, so you didn't mention Central Bank of Brazil, Central Bank of Turkey, and the Central Bank of South Africa, the Swiss, they're all deciding. And when they look at their nominal effective exchange rates, they'll all be looking at the Fed. How long can the Fed's projection keep the dollar strong? And then they'll have to calibrate their own forecasts.
Is that dollar problem bigger in Europe right now for you than EM?
I think that dollar problem is bigger in Europe because EM, across the board, if you look at Brazil, for example, much higher real rates. So they've got the buffer. Europe does not.
Georgieva surprised us with a low 5-year growth view. Suddenly, oil 94. For Jeff Yu, where is the price of Brent that's a tip point that really accentuates that global slowdown?
Let's look at the individual markets. For example, China's at a slowdown already, no matter what China, unless you're looking at a real re-acceleration in China, which is not my base case, to 5 or 6%, then you get into a demand issue on top of a supply issue. That becomes a problem globally, and then that could be a tipping point. But right now, if it's just the US alone, and given US energy independence, I think it's much more manageable.
I'm glad you mentioned China. The Wall Street Journal had this big expose. China might be weaker than you think, and talked about focusing on the housing market. Other people have said, including Leland Miller of the China Beige Book, that from a U.S. perspective, this is what people want to see, but it's not actually what's happening on the ground, that there's actually a great deal of strength. Having been in China a couple of times recently, what's your view?
So domestically, I thought consumption was firm. So I was there about 3 weeks ago. People were spending. Some of the key tourist sites, like in Xi'an, the Terracotta Warriors, was basically several rows behind before you could actually see the soldiers there. But then on the way out, look at Beijing Airport. Just barely any international flights coming out. So that higher ticket consumption items, I think that's a bit more of a problem at this point. Going back to the real estate market, there's close linkages to the financial system in China. Stabilizing the real estate market means stabilizing the financial system, especially the trust and framework, shadow banking, for example. So that's where I think they are doing the right thing. But ultimately, how much more downside can you price in, relative pricing? I think it's very limited.
Do you partition China into domestic balance sheet challenges, even out to Chengdu, or do you drag that into the more international analysis of renminbi and the rest? Do you partition or not?
So I think at this point, China's pretty much self-financed. We look at our inflow data. International financing for China's growth is very, very limited right now. So it's about domestic financial stability.
I agree.
And then the transmission is, if things go awry, can that drag down international growth further?
We've got to squeeze this in, Jeff. We're in Europe. There is an EV battle taking place. And to a greater extent, I think the transition to EVs is at the epicenter, the heart of this conversation with UAW and the Detroit 3 at the moment. Are we heading towards just massive tariffs for auto imports in places like Europe?
If you asked me 2 weeks ago, I would have said no, but I think something changed at the Munich Auto Show.
What do you think changed?
I think for the first time in 3 or 4 years, Chinese came back and European manufacturers looked at how far they were behind, not just in terms of cars, battery technology, and realised this is much more pressing than we thought, and you saw the reaction.
German manufacturers are scared of what's coming out of China.
Absolutely. And China saw this in advance. That's why they want to build in Hungary battery factories, and they want to build assembly plants in France as well. But even then, with that kind of cooperative approach, you're seeing the backlash already, and then you're seeing the backlash from Beijing. So this is going to get interesting.
Now, this is only one industry, but do you think there's broader things at play here that ultimately influence things like flows that contribute to causing foreign exchange?
I think medium to longer term, let's look at the chip industry as well. That's going to feature heavily in terms of flows into Asia, into Europe. But the importance to employment, especially in Germany, and also at Eastern Europe, that feeds into the German supply chain.
Poland.
I think this is, and politically speaking, this is absolutely going to be central to Europe.
Jeff, this was fantastic. Great to kick off the week with you here in London. Jeff, you there.
My pleasure.
Of BNY Mellon. Bramo, I'm with Jeff. I think you are too. Something did change on this front in the last couple of weeks.
And we had reports that some of the auto manufacturers in Germany were shocked at how much further ahead they are. Not just that, but have more access to the lithium underpinning this because they own that market. So at a certain point, if you can't compete, you regulate.
Well, it's not just tech, is it? It's not just the supply chains. It's cost.
Exactly.
It's cost.
Yeah.
And that's why I think these negotiations with the Detroit 3 and UAW just get bigger and bigger. When you start seeing 20% getting declined, how do they compete with Chinese EVs?
And this is what they're saying. How are we expected to remain profitable? How do we survive this if we're trying to compete with that? And the UAW said, figure it out because we don't want to lose our jobs.
Big story for us this week. The other one, of course, it is Bramo's birthday week. With us all week in London, Andrew Balls of PIMCO is coming up in the next hour. Live from London, good morning.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's SIBO, the exchange for the world stage.
Powering financial solutions that transform industries. Powering seamless execution in evolving markets. We deliver our entire global bank to power new possibilities for you. Barclays Corporate and Investment Bank, powering possible.
Stellantis said they've offered 21%. What are you expecting out of tomorrow's negotiation with them? That seems forward movement.
We've asked for 40% pay increases, and the reason we asked for 40% pay increases is because in the last 4 years alone, the CEO pay went up 40%.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
Sean Fain, UAW president, speaking on CBS. We're living in a world where 20% wage increases do not get it done. And a difficult moment for the CEOs of Detroit's big three, GM, Ford, Stellantis. Lisa, how do you respond to this? When a CEO pay goes up 40% and they turn around and say, we're offering 20, you say you got 40, why shouldn't we? What does the CEO say?
The CEO says you're going to put us out of business, which is what they're trying to say, which is the reason why Ford came out last week with layoffs at a certain plant that was affected. So at what point does that translate at a time where there are going to be layoffs anyway? And they're trying to get the little power they have remaining before there are some pretty massive changes.
Obvious comeback as a journalist to that question then, TK, is ultimately if 40% pay increases mean you face existential risk, why are you getting one?
Oh, there's almost existential no. It's going to be interesting to see what the auto companies say. What I saw was a preponderance of pseudo-engineering analysis about putting an internal combustion engine together versus an EV. And there's some real stark differences there. There's some very good work on it this weekend. My answer is, so what? This is a cultural statement, which is simply, we sacrificed into your bankruptcies. Good morning, Dearborn. Ford, you didn't go bankrupt. And with that sacrifice, we need to get, what? Some payback? I think that's where we're heading.
Question of the week, Tom. How long a visit will it take to have TK and Bramo pronouncing aluminium correctly? Never mind
well,
petrol
that,
and
but
diesel.
we're still going to do copper out of
Lisa?
Chicago.
Well, it just depends on a will. I mean, it's not sort of an incapability. It's just aluminum sounds better.
It's not about ability, it's about willingness. OK. Equity futures on the S&P, totally unchanged. We're going nowhere. Looking at the bond market with yields a little bit higher by a single basis point. 434.45, very close to cycle highs. Looking at crude through 91 on WTI. We're talking about new highs for 2023. And a euro weak for 9 consecutive weeks at a close last week. The euro this morning slightly stronger, Tom. 106.71.
Sterling weaker too. There just wasn't a bid to sterling off the weekend, Friday through this morning, breaking through 124, and you know, back at a 124 level right now. But John, sterling needs a bid too.
Coming up to the anniversary of the Liz Truss budget here in the United Kingdom.
Getting some press.
Lots
on
of
that.
fun and games. Is that why we're here?
No, but you know,
Make it up.
it's getting. Look, I got my bow tie tied like.
Did you see what a certain former governor of the Bank of England, Mr. Carney, said?
I saw that.
Some of that, yeah.
On the channel.
Yeah. That it was not Singapore on Thames, it was Argentina on the Channel.
I read every word of that.
Yeah.
That was before.
What did you make of that address?
I thought it was very carefully worded.
Okay.
I thought that I read the entire address, and I thought it was a very careful statement. And, you know, they'll move forward in the debate, but even more important, Everton lost to Arsenal. So
you watched that game?
I had to watch it. Governor Carney told me I had to.
Okay, because he's an Everton fan.
Yeah.
I did not know that,
I
but there we
survived
go.
it, to be honest. Right now we're going to survive American politics. Gregory Valliere briefs us this morning. Chief U.S. policy strategist at AGF. Greg, in the Washington Post, they talk about 5 ideological factions of the Republican Party. I didn't know that. Do you actually buy the idea, given labor unrest in America, given a possible government shutdown, that Mr. McCarthy's dealing with 5 ideological factions?
Oh, at least. Yeah, it's quite a spectacle right now. He's on really thin ice, Tom. I don't think he can get a deal before the October 1 deadline. So we do have a shutdown. I call it shutdown light because it's not going to be the end of the world. We're not going to kill Social Security and Medicare benefits. But if you want to go to a national park, you're out of luck. And I think the shutdown is going to last for quite a while.
Is there a shutdown in Detroit? What I find stark is the imagery and the great coverage by Bloomberg on this. You know, I see them picketing and there's like 7 people out front. It looks like a lineup at Denny's waiting to get in. I mean, is this like a real strike of labor like you and I remember? Or is it sort of kind of like pretend?
Yeah, it's not like what we remember that everybody went out and you didn't selectively target factories. But I think there have been some sign of progress. I think Ford has been the most conciliatory. And I think the elephant in the room, obviously, is Joe Biden. I think Biden knows that Michigan has 16 electoral votes. And I think Biden will be influential in the final agreement.
What will that entail? Do we have a sense of what it will take to get it done and what that means for the viability of auto manufacturers that have traditionally added to the GDP and really fostered a lot of strength in the Midwest?
Yeah, I think it will have to be close to 30% in wages. 40% is out of the question, but I think the number will creep up. They may go back to more like defined pensions. They may have less than a 40-hour work week. It will be generous, and it will add to the perception that wages are sticky for the Federal Reserve. I think sticky wages are going to be around for quite a while.
Does this pressure, just sort of uniting the two ideas, does this pressure lawmakers to try to get a budget deal done just to avoid the extra hit on that front, especially at a time where there might be some agreement on things like border control between the Republicans and Democrats?
I tell you, Lisa, these people are on a different planet from you and me. They are fighting these parochial fights knowing they're going to lose. I mean, it's quite clear that this compromise over the weekend would never make it through the Senate. I'm not even sure it would make it through the House. So we're going to go through this exercise. And sadly, I think this drags on right into the holiday season, maybe after the holiday season, before we get a deal.
Greg, I got to turn the script. Once again, over the weekend, lots of discussion about the president's age. I think all of our listeners and viewers are sort of exhausted by the debate. But I want to know the Valliere timeline to where I get an LBJ announcement like March of 1968. You and I were sitting on the couch watching the Bruins lose when that happened. How do we get Joe Biden out to where LBJ was in March of 68?
I don't think he realizes there's a problem. More and more Democrats I talk to, almost all of them, as a matter of fact, say they would like to see Biden step down. 2 problems. Number 1, he is delusional and he doesn't think there is a problem. Number 2, there is no logical successor. That's the problem for the party.
Do the polls scream, Greg, that there's a problem?
Absolutely. I mean, about 70% of Democrats say they would prefer a different nominee. I mean, that I've never seen a gap like that. So you could have more pressure. You know, the other thing, guys, I should mention is that filing deadlines are fast approaching. By late October, early November, it's too late to file. So any talk about some last-minute rescue for the party, I think, is unwarranted.
Greg, before you go, have you heard about that missing F-35? Have you read the story on that?
The missing what?
F-35 fighter jet gone missing.
In the Carolinas.
And
Greg, what on earth is going on? How does the military lose an F-35?
I know, it's quite a story, and I think it's going to get bigger.
Greg Valliere of AGF, thank you, sir. If you don't know what I'm talking about, I'll share the Washington Post story with you.
Greg, thanks.
It reads as follows. An advanced F-35 Lightning II jet went down somewhere near Joint Base Charleston on Sunday afternoon. And the pilot ejected safely and was in stable condition, the base said. But the problem is that the responders aren't sure where the plane ended up. Believe it or not, the jet's transponder, which usually helps locate the aircraft, was not working for some reason that we haven't yet determined. So we're sitting here, and somewhere, someplace, there's an F-35 that the military can't find?
It raises questions about whether someone interfered with its signals and then maybe took it somewhere else. Well, I mean, what else can you really start to question where things went?
I question the moment I saw the news, to John's good point, John, I'm glad you brought it up, the conspiracy theorist people will click in here with a vengeance. You know, there'll be an investigation. Obviously, somebody screwed up big time. That's a piece of hardware.
What blows my mind is that at some point on Sunday, there was an F-35 just sort of flying through the sky on autopilot without a pilot. Like
it doesn't make any sense.
That makes no sense at all.
Correct.
It's incredible. Okay, we'll see what happens with that story.
I think it's really interesting, too.
I'm pleased you're on the same page. Madeline Jones of Oaktree is coming up. Before we get there, let's check out the price action for you. Equities on the S&P 500 up by 0.1%, just a little bit higher. And the bond market yields a touch higher as well by a single basis point, 434.25. Huge week for central bank decisions. Wednesday, the Federal Reserve. On Thursday, the Bank of England right here in the City of London. Then on to Friday, it's the Bank of Japan. Live from London this morning. Good morning. Equities shaping up as follows on the S&P 500, slightly higher, nudging higher by 0.1%. Likewise on the Nasdaq 100, just drifting higher by 0.15, coming off the back of a really mild week of losses on the S&P for a second consecutive week. Into the bond market, hardly talked about, but worthy of attention, a 10-year yield, very close to cycle highs, 434.25 on a 10-year right now, yields up by a single basis point. The intraday cycle high on a 10-year was back in the summer, late August, Lisa, 436.18. We're not far off, are we?
And how much is this being driven in part by the wages that we keep talking about, this concern that wage price spirals are going to keep boosting inflation, or how much is this driven by something else with budgetary reasons? Either way, it to me is underpinning the tech underperformance and a lot of the questions in markets going forward.
I'm going to go all Neil Dutta on you here from across the pond, and Neil Dutta would say it's probably a burgeoning economic recovery and a real buoyancy to it with some demand function, which just lifts up yields into maybe a higher nominal GDP than anybody imagines.
Do you want to throw crude into that as well? 94 Brent, 91 WTI?
Yeah, I mean, what part of EM? We've got Christian Mela coming up later in the week with JP Morgan. To me, that's a key interview here. He's going to reframe EM demand for oil. Granted, it's a shock to see how fast oil's moved. And this morning, I think we saw 94.74 intraday high on Brent crude. That's shocking statistics.
It's amazing to see it, Tom, this close to triple-digit crude at the same time, yields near cycle highs, when we were meant to be talking about recession at the end of the year, according to the outlook at the start of the year. I want to finish on foreign exchange. 9 consecutive weeks of dollar strength against a weaker euro. The euro right now 106.72, showing a bit of strength and positive by 0.1%. Standout decision of last week, ECB President Christine Lagarde rocking a hard place, TK, and hiking into it.
Oh, yeah, under 107 is where euro is, and we'll have to see how we do. 1 bank, 2 banks, 3 banks this week as well. But the answer is we've got resilient dollar, and Jeffrey, you made clear short term that will continue.
Dollar strength, and maybe, according to Jordan Rochester over in Nomura, we come back down to about 105.
105.
105 on the euro. Under surveillance this morning, TK said it. Key week ahead for central banks, starting with the Fed on Wednesday. Traders expecting a pause, while a rate hike from the BOE on Thursday is seen as likely. The BOJ rounding out the week with their decision coming on Friday. Out of those three, Bramo, what stands out for you? Fed, Bank of England, or BOJ?
I think it has to be the Fed and the statement of economic projections in particular. People looking at the dot plot and understanding if they upgrade financial growth
this time around.
Yeah, but do they upgrade their expectations for the economic growth in this country, and then do they just assume inflation can keep disinflating immaculately, or does that raise some serious questions about how far they have to go?
Well, you say, will they upgrade? Are they going to mark to market their forecast?
Okay, same thing.
Basically,
yes,
because they got it wrong.
Exactly.
This economy's been so much better than people thought it would be, and based on the incoming data, Tom, we're expecting that GDP revision up, inflation down. It's 2024 that's going to catch my eye.
Yeah,
where do they see 24
absolutely.
going, and how much wood is there to chop? How much can you push against those rate cuts that people still expect later next year?
To your point, and Lagarde didn't go all Draghi on us and give us a lot of certitude about 2025. You're not going to get that from Powell. These guys are going to be focused on a massively data-dependent set of meetings into next year.
Pretty sure Lagarde's just desperate to get through 2023 before talking about 2024. The update on UAW, President Sean Fain rejecting a 21% pay increase from Stellantis as the strike against the three major US automakers rolls on. The offer coming in well below the 36% raise the union is seeking, with Fain calling it a, quote, no-go, signalling the union and the automakers remain far apart in negotiations. If you follow the interviews, Lisa, I do find it curious. Is it 40 or is it 36? It dropped from 40 to 36. Then in conversations I've heard in the media, he's still talking about 40.
So I don't really understand, and we don't understand what the line in the sand is and what they're pushing for. Either way, it seems like the Detroit automakers are already paying vastly more than Tesla, for example. They're paying about $66 on average versus $45 on average. And Wells Fargo estimates that if they conceded to all of the demands, that would go up to $136 per hour on average for all of their employees. So that's what we're looking at here.
The final story is just to make people living in Manhattan feel better about themselves. Britain's property market breaking another record. Rents growing at the fastest pace in at least a decade, while homeowners pushed up asking prices for the first time in 4 months. Tenants paid 12% more than a year ago, according to data from Hamptons, with the average rent in the UK and Britain now £1,300 per month, the highest on record.
Give us an anecdote, John, of all your contacts, particularly in the Midlands. You know, give that I don't need the details of family and all that, but give us a John Farrow anecdote about how people are living this.
I won't share a personal anecdote, but I think we should do the compare and contrast. It is so different in the UK because of the mortgage market structure. And Lisa, you and I have talked about this a million times. If you've got a 30-year mortgage in the United States, sit on it, hold on to it. Tease people about it, bully them if you want. I don't know what happens around the dining table. That's what Bramo does to me every single time with their 2% mortgage. But you're going to hold on to it, Lisa, and you're not going to sell. In the UK, that dynamic does not exist. So you're going to see that effective rate in the mortgage market in the UK come up much more higher, much more quickly than you're seeing it in the United States at the moment.
And how much does that really sort of fortify some sort of wage price spiral if people are realizing that they cannot live with the same salaries at the same levels? And so it just keeps going up, and it's just this whole kind of, you know, spiral.
So Governor Bailey's got short and fixed non-legs. Is that what we call that?
Well, Bailey's also staring down the barrel of something like 8% wage growth as well.
Yeah.
Inflation dynamics in the UK are very different. What's intriguing about the BOE decision on Thursday is that I see a lot of people are expecting a rate hike. Then I look at the recent communication from the core of the Bank of England. They're not screaming rate hike on Thursday at all. So there's a bit of a divide, I think, between the communication I'm hearing from Threadneedle Street and what the economists here in London are expecting on Thursday.
Yeah. I was having my hot brown water this morning. Kathleen called in.
Okay.
My phone rings. It's Kathleen. Kathleen says, my daughter's going to be on with you today. Can you be sure you pronounce her name right?
Are you going to pronounce it right now?
Madeleine. It's not Madeline. It's not
Madeleine.
like Bemelman's Bar or, you know. Madeline
it's not Maddie, it's Madeleine.
Okay. Kathleen, thank you so much for informing me. Madeline Jones, good morning.
Thank you so much.
What John just talked about, you know, we talk about it in Cosmic, but you live the non-fixed floating rate market. If you were to speak to your mother or anybody else today, what does your world of floating rate debt at Oaktree do to the people of the United Kingdom, or for that matter, adjusting out over time in the United States?
Well, the floating rate market So we're mainly talking about loans here, bank loans, which are supplied to single B average quality credit companies. And so these were structures that were put on back 3 years ago, maybe more than that, when floating rate was negative in Europe. And they weren't designed to contemplate the sort of rate hikes we've seen in the environment.
So when they reset, it's, to be clear here, price up and the asset value goes down.
Well, I think it's not as linear as you're making it out to be, because it comes back down to what's the structure of that balance sheet look like, and can that company tolerate that inflection of floating rate underlying rates that we've seen. Some companies can and some companies can't. I think the good news for Europe is that a lot of companies can tolerate it. They have not got debt maturities for some time, so some of them with a fixed rate market won't have to reset that debt. And also, you know, we've had 2 or 3 years of quite shocking environments, not just COVID, but also the Ukraine invasion in Europe. And so companies have been quite conservative with their balance sheets, paying down debt, but not making big acquisitions, not doing shareholder buybacks and dividend payments, becoming a little bit more aware of the fact they've got rising cost of debt that they've got to deal with. So although we do believe there's a cohort in there which is structurally challenged because of the balance sheets they put on years ago, we don't think it's a huge insurmountable problem for the market.
Can we build on that a little bit more, just the difference between the transmission mechanism in the United States and in Europe, given so much is done through the banking channel in Europe compared to, say, the United States? Does that mean the speed, the magnitude of the pass-through from rate hikes into the real economy is different? How does that work?
Well, you're right. On the corporate side, more floating rate corporate debt. So the feedback to the corporate is very quick, but the transmission mechanism to the consumer is still quite slow. And I don't think we've clearly not seen that yet. And I think for managers, you have to decide whether you feel as though, you know, can we rely on that consumer still being robust and the broader economy still feeling isolated from that, or is that something that's delayed and is coming further down the track and a recession may be just pushed out, you know, a year or so down the path.
But this is sort of a what goes first, a chicken or an egg kind of question, right? When will the transmission effects actually go into the economy for the consumers, and then for what we're seeing at corporations? In the meantime, borrowing costs don't seem to have torpedoed corporate models. Why is that? Why have things been so resilient after 10 years of people warning that it would be Armageddon if we got anywhere above zero?
Yeah, well, I think it's partly delayed because the fixed rate part of, you know, the high yield bond market, and a lot of companies have a mixture of fixed and floating debt. So they're seeing the immediacy of those floating rate loans impacting them. Some of them hedge that out, so it may not be as clearly impacting today as you might think. But with the fixed rate, they're going to have to wait till the debt matures before they really feel the pressure of that rising rate. And maturities, you know, they aren't that significant this year. Next year, they start to creep up. In 2025, you'll see a much higher rate of need for refinancing at that higher cost.
So as an investor, how do you get in when the going is good? How do you know when there are opportunities, when you're expecting distress to come down the pike in a more material way, when you see the potential for yields to go even higher, but already are able to capture quite a bit of yield relative to where it used to be?
Well, that's the whole job, is to dissect that, and I think the market is pretty good. You know, frankly, the market's pretty good at that. It's already for quite some time decided which of these company balance sheets are just not sustainable, and these are trading at 70 cents on the dollar, you know, something like that. But it's around 5-6% of the market is down there, and the market's saying that is a structurally impaired balance sheet which will need an equity injection, a restructuring, can't survive in this higher rate environment. But for the rest of the cohort, a large, significant, sizable market is going to be fine and weather the storm. It's just thinner. You have to be very, very careful. Default avoidance is in our DNA. We have to focus on protecting ourselves against default and really stress test that thin layer of cash flow which is left in some of those companies.
Crane's a moment ago in New York, the real estate people published an important article for New York City, which is that old buildings have an uncertain future. I'm going to assume for Oaktree, old buildings with an uncertain future is a huge opportunity. How do you play commercial real estate in London? in Manchester. Manchester's north of London?
Manchester is very much north of London.
How do you play it across the United Kingdom and not in the romantic fancy spots like the skyscrapers around us here? How do you play commercial real estate as an opportunity?
Well, I think that's where you have to have that analytical team that understands the difference in the geographies and markets and what's the supply-demand fundamental looking like within a location. It can vary. The great thing about Europe is that it's so varied across so many different geographies that makes it very interesting for people like me to find.
Well, where's the city? I mean, nobody's
places.
listening. Where's the city that has an opportunity right now?
Well, I think corporate real estate isn't in my wheelhouse. I'm more in the corporate debt market, so cash flows are the predominant mainstay of my investing potential. And you'll find lots of good companies across lots of good markets. Some of the places we've been rowing back from have been traditionally some of the best because they tend to get over-levered.
Name them.
Well, one, I mean, as a geography, as a geography, when I look at our portfolios, everything is built from one issuer, granular up. It's not taken on a top-down. But when you look at us in a portfolio where we were a year ago, where we are today, somewhere like Germany has become a lot less significant in our portfolio.
Interesting.
Because we found, a lot of industrial Germany was successful because it relied on lower cost of energy. And now that dynamic has changed, and admittedly they did a brilliant job of shoring up that energy shortage crisis we were very worried about. But it is still structurally more expensive, and that challenges the competitive nature of industrial Germany. So for us, we've tailored back down some of our exposure there. It's things like that. It's all built from the bottom up.
Yeah.
You can start to see a picture of where those bets are taking place.
Fascinating. Madeleine, thank you. Madeleine Jones of Oaktree. You want to do a shout out to Madeleine's mom again?
Kathleen, I hope I nailed it.
Okay,
Madeleine.
good. Okay.
Madeline.
All right. It's Madeleine. All right,
I know Madeleine for the Bellman's Bar.
Are you flirting with Madeleine's mum?
No.
Is that what's happening here?
You know.
And Rita said,
Kathleen briefed me.
Energy Aspects on $90 crude up next.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Und genau das treibt uns auch bei Bayer an. Mit Hilfe der Wissenschaft verfolgen wir unser Ziel: Health for all and Hunger for none. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können. Bayer.
Should they worry about $90 crude if it's just a supply shock? Should they worry about that?
They should. I mean, otherwise they're going to repeat the same mistakes they made in 2022. In some cases, prices were falling, energy. Services were inflating, but if you wait long enough, services will start to disinflate as well. And the fear was that goods would start inflating. Now we're seeing goods are going to start to inflate. And that's, I suspect, will keep people up.
That was Mohammed Al-Arian of Queen's College, Cambridge, speaking to me on Friday on the impact of higher oil, potentially for the Federal Reserve, which meets on Wednesday. Crude this morning, 91.45. Brent crude having a little sniff of 95. This is stuff we haven't seen, Tom, for all of this year through 2023. And crude is at the heart of everything, I think, right now that we're talking about.
You know, three of us got together. We almost never see each other, folks, because of the crazy New York schedule. And to have a full English, all three of us, was really something here this morning. And
OK,
John,
let me cut in. Headline. I come downstairs today. TK's having a fruit bowl. It's a fruit bowl.
Yeah.
You were there for it.
Yeah, I saw it.
Well, there was witnesses.
That was new. What came before the fruit bowl is what I want to know.
The full English.
OK, all right. Good to know, TK.
You nailed it, John. And to me, the lead story this morning for global Wall Street isn't happening. And the bond market is moving. It's fractional. We're all jaded by it. But nevertheless, the levels we're quoting, the real yield, Lisa, you mentioned 1.99. These are substantial numbers. And they change the dialogue of these three Fed meetings, particularly the one we're underplaying at 147 yen, which is Japan, the last one.
I like what Mohammed had to say, that this really speaks to this question of goods disinflation and goods reinflation because of petrol and how it influences everything in terms of getting things from one place to another, and transportation costs as well as production costs.
I'll ask the question that I asked Mohammed of you then, Lisa. Do you think it is something the Fed can ignore? on Wednesday?
They can't ignore it. They're going to say it's transitory. But at a certain point, if they start to see goods reinflate, can they say that's transitory too? Can they say that that's manipulative? How can we know if we don't know whether the oil price is higher because of demand or simply because of the supply cuts?
What's the single effect you get from the wage negotiations with UAW and the Detroit 3? TK, I think for a lot of people who have their annual wage negotiations, looking at what's happening in Detroit kind of matters. They want a bigger share of that. Aren't they going to be more emboldened to go and ask for
Lisa was at Teterboro, Middletown, I can't remember which, getting on the Gulf Stream, and she put out that chart on union, and it's really spiked up. I mean, it's back 10, 15 years to the angst we're seeing now, and I do agree it percolates, maybe is the right word. It percolates, like what the percolation of water you do to make hot brown water.
Okay.
You know,
do you want to explain what you think hot brown water is? You're calling tea hot brown water?
Well, I was watching. I watched Richmond this weekend. They got relegated, but I watched Richmond, and you know what was great was walking down the street in West Ham. People were walking by me, like to the.
Where did you go?
Ballpark. I was like
to the ballpark.
Yeah, they're going to the ballpark.
We're going to stop this now. Brent crude 94.53, TK WTI 91.54.
Let us move on. Amrita Sen joins us to save us here from the ballpark, co-founder, head of research at Energy Aspects, and critically joins us this morning from Canada, which is an oil producer. Amrita, within your racket, within your industry, are they looking at this as a surge that can ebb, or is there a feeling, you know, within the macro petroleum business that this is a new pricing to stay?
Well, it's still early. It's not even 5 a.m. here, so I don't know how they're feeling. But if I had to guess, Tom, I would say they are all going to be very happy. I mean, of course, there's World Petroleum Congress over here. Ministers from all around the world are gathering, including Prince Abdulaziz himself. There's lots and lots of kind of talks with both consumers and producer governments really over the next couple of days over here. And I think the reality is that demand has surprised to the upside, regardless of all the recessionary fears that we've seen. Right. And I think that's why what is interesting for me is, yes, crude is getting all the headlines now. We're talking about it. But if you look at products and crack spreads, that have already been high for the last few months. Gasoline, diesel, they've been trading at $120+ per barrel. Crude was 80. Now crude's catching up, but those prices haven't necessarily gone up further. So this is more of a redistribution between refiners and producers than really end users feeling the impact. So I know why the media is focusing on the crude, but I don't think the end user is necessarily seeing that big an impact versus a few months ago.
Right. What is the representation or tone of China is the marginal demand elephant in the room at the Congress? Is China there in a big way?
I think there is going to be presence for sure. And I think, again, the dichotomy between Chinese macro and Chinese oil demand is definitely going to come up, something we've been highlighting for some time now, because in the West, and Western analysts keep looking at the Chinese macro data and saying, well, oil demand hasn't been performing yet. Oil demand has actually been hitting record highs because it's become more consumer oriented. Plus, China's got some strategic petroleum reserve filling going on as well. In some ways, the U.S. has been drawing it down last year, and China now is actually refilling it, having locked in some favorable prices earlier in the year.
What's the pressure on Prince Abdulaziz today, who's going to be speaking, I believe, around 10 a.m. Eastern time at the Calgary conference, to really increase production, especially if this is being driven in part by demand, not just their supply cuts?
Well, I think he's been very clear that, look, there still is a lot of uncertainty, be it from the Fed itself or even China, all the kind of noise that's coming around. And he has to be 1,000% confident, I would say, not even 100%, that there are not going to be any of these, surprises with the Fed, for instance. And it's a bit of a chicken and egg, right? If oil prices go up, what does the Fed do, as you guys have been talking about as well? But I think they are going to be cautious. They want to ensure that balances, or at least inventories, do not build because of those macro concerns. And look, Saudi Arabia has extended the cuts till year end. So has Russia. It kind of gives, for them, the main thing they want to provide is stability. And I think that's what he's trying to do. And I think that's what he's going to focus on today.
It's a really interesting confluence of events. At the United Nations, they're holding a conference right now where a lot of the focus is going to be on sustainable energy and moving away from fossil fuels. You have electric vehicles taking over. That is underpinning some of the discussions with the UAW. How much is that underpinning Saudi Arabia's decision to cut production, to get more profits now before some of these groups phase out fossil fuels, before they become less of a focus later on?
Well, you could argue that goes both ways, Lisa, right? I've also heard the argument that that's why other countries want to flood the market and make sure they don't have stranded assets afterwards. I don't think OPEC plus policy works like that. We've written about this as well, that ultimately Saudi Arabia and most OPEC countries are revenue optimizers, right? What they are trying to do for themselves is saying, okay, if this is the price and we cut production or raise production, what is our total revenue going to be? That is what they're focusing on right now. Of course, they're concerned about long-term energy transition, but I wouldn't even use the word concerned. I think they embrace it. They are doing a lot around it. And they very much are aware that oil has to fade over time. They just disagree with the timelines like the IEA has put out.
What's the Amaretta Sen timeline of an oil vector, I guess, in June or July of 70-something up to 94.51 right now? Is that just a continued vector up? Do you see 95, 96, 97, et cetera, et cetera, et cetera?
Yeah, if you remember, Tom, our price forecast for Q4 was an average of $92 for Brent. So I think we've kind of hit it now. So the question is, but look, an average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, you know, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
A triple digit by Halloween, Amrita, is that just a marketing mechanism? Just, you know, triple digits, Halloween, or is there something about the next month?
No, it just rhymes, right? 100 by Halloween. That's why. No, I'm joking. But it's just, no, I think, look, fundamentals are very, very strong right now, but also positioning. And that's one thing we shouldn't miss. A lot of hedge funds are very underpositioned in crude because of the macro concerns. Now we are seeing quite a bit of passive money come back as well. So I think the combination of that could actually lead to a temporary kind of upswing in crude. And that's why I'm not saying we're not expecting it to average above 100, but it could go above 100 in the next couple of weeks.
Only $5 away right now. Amrita, thank you. Amrita Sen of Energy Aspects. We'll run with that headline. $100 crude by Halloween, TK. It's just around the corner. It's hardly a call at the moment, is it?
Got to change my outfit for Halloween.
What are you going to wear? A barrel of crude?
Yeah. I don't know. Go as a barrel. I like that idea.
We once joked we'd go as QE, TK, QT, and all of that good stuff, and now it's $100 crude.
I don't think this is a small idea. Javier Blas talking about Arab Light already there, and you know the way he looks at it, I don't understand it, but that's what he said. And
94.51 on Brent. I've just seen him out the corner of my eye. Andrew Balls of Pimco coming up next. Very cool. With us here in the studio, here in London. Live from London this morning. Good morning to you all. With equity futures slightly positive, this is Bloomberg.
Die Welt zu einem besseren Ort zu machen, das treibt uns Menschen an. Ob im Beruf, in unserem Zuhause, dem Auto oder auch beim Kaffee am Morgen. Wir möchten unser Leben verbessern. Es geht dabei nicht nur um uns selbst, sondern um alle, die uns wichtig sind. Und genau das treibt uns bei Bayer an. Unser Ziel? Health for all and hunger for none. Mit Hilfe der Wissenschaft kämpfen wir gegen lebensbedrohende Krankheiten. Wir wollen, dass alle in eigener Verantwortung mit ihrer Gesundheit umgehen können. Wir wollen eine Landwirtschaft, die alle ernährt und dennoch die Erde schützt. Wir wollen, dass jeder Mensch die Chance auf ein besseres Leben hat. In einer Welt, die wir mit Stolz an nachfolgende Generationen weitergeben können.
We've yet to see the full effects of the previous tightening come through into the real economy.
We have structural imbalances here in the U.S. that no one wants to deal with in Washington.
The bigger concern would be that things get unruly in China.
I think the Fed is going to be paying very close attention to the path of energy prices ahead.
The Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from London, on the edge of saying good afternoon for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500, just a touch positive on the S&P. Going into a massive week for central bank decisions. Wednesday, the Federal Reserve. Thursday, the Bank of England. On Friday, TK, the BOJ, just around the corner.
Translated with $94 oil, up goes a gallon of gas. I know they don't pay attention to that. Somehow I think they will on Wednesday, and I would suggest the governor of the Bank of England, you ready for this? $7.24 for a gallon of petrol in the United Kingdom.
That's real money.
That's real money. I mean, you know, we don't look at that. The cars are smaller. Lots of electric vehicles here, way more than I would perceive in the United States. But I'm sorry, inflation's there. And as you said earlier, John, at our leisurely English breakfast, full English breakfast this morning, it's just real simple. I mean, all in, inflation's a story, higher yields.
Look, this hurts, even with 7 to 8% wage growth in this country at the moment. There's a lot of difficulties here in the UK, just as there are over in the United States right now. Did it get harder? At least at the moment, we're looking to a growth forecast from the Federal Reserve on Wednesday that is set to be revised higher for this year. I've got no idea what 2024 looks like.
Recession coming.
Reflecting that, to some extent, yields near cycle highs, crude near the highest we've seen it for the whole of this year. Bramo, these kind of things, I'm going to borrow your word, percolating and hardly been talked about this morning. I find this bond market move 434 right by intraday cycle highs, and I don't see a headline anywhere on it at all.
And it's being driven by real yields, which means that the inflation adjusted, the expectation of inflation baked into the market versus the actual yield is the actual yield is the highest going back nearly to 2009. We're bumping up against 2%. At what point is this a statement about some of the wage negotiations on the heels of some of these price increases, pointing to some sort of wage spiral? And at what point is this pointing to some sort of fiscal pushback? And at what point is this just great yield, go get it, because you're not going to get it for very long?
I'm not in the rate of change of a quote-unquote wage spiral and all the emotion and baggage of that from the 1960s, but Andrew Balls is over here next to me. We're going to bring him in a moment. He's nodding his head on real yields. And the key question for me is the benchmark real yield that the pros follow is a 10-year yield. And the answer is the 5-year real yield, to me, has uncommon value. And I'm sorry, it's a melt-up. There's no other way to put it.
We'll return back to that in just a second. Just to give you a flavour of what's happening cross-asset at the moment, futures slightly elevated by 0.1% on the S&P 500. Last week, a very mild week of losses on the S&P for a second consecutive week. In the bond market, yields a single basis point higher at 434.25. And just to finish on the euro, Lisa, 9 weeks of dollar strength against a weaker euro. We're trying to bounce back from that. 106.67 on the euro against the dollar.
The FT did a poll of economists. 40% of them expect more than 2 more rate cuts or two more rate hikes, at least in the next couple of years. Today, we're looking at oil very much front and focus. 10 a.m. we get some words from Saudi Energy Minister Prince Abdulaziz bin Salman speaking to the World Petroleum Congress in Calgary, curious how he dovetails supply versus demand. How much of the increase in crude really has come from a stronger than people give credit to China and just the rest of the world. Today, sort of in contrast, you hear a lot about electric vehicles and renewable energies at the UN General Assembly, which is a beginning. We're also going to hear from perhaps a discussion with the U.S. and China. More on that later.
Just to say that's why we're here.
What? Because
to avoid this.
100%.
This is like the worst week of the year living in Manhattan. Unger. It's just, I hate it. The traffic everywhere. I wish they'd move it. Yeah. Maybe that's controversial. I don't know. I wish they would move the UN General Assembly
Afterthought
out of New York,
being
out of
shut down
Manhattan.
this week.
Well, yeah. Honestly, we all had the same thought. How lucky are we that we get to be in London?
Take it to Queens.
Okay.
Meanwhile,
so it's also, of course, celebrating birthday week. We'll have to do this every year. Today, also, we're kicking off a monthly week of monthly housing data. This is when all of the data gets dumped out, including today at 10 a.m. Eastern, the NAHB Housing Market Index. This comes as affordability hits the lowest levels, at least by this measure, in the United States, going back to when this series was created in 1986. This raises a question
What goes first, the price of houses, or do wages just keep going up to respond to this?
That's all the data, the look ahead for today, and a sneak peek of the rest of this week as well. With us around the table, you've got a sneak peek of this. Andrew Balls, Global Fixed Income CIO at PIMCO. Andrew, good morning.
Good to be here. Thanks very much.
10-year, fantastic to be with you. 434 on a 10-year yield this morning. To build on what Lisa said, is this a moment in time? Buy, lock it in before it goes away, or can we live with this?
So I think it looks pretty attractive. We're in the middle of our forum discussions, which we had in London as well, actually. So we're still talking about this with the investment committee.
Give us a head start.
But it looks pretty attractive here. If you have a high quality bond fund, 5-6% yield in US dollars with more credit, kind of 7%, maybe 7.5% yield, this looks very attractive. Equities have done very well this year. Looking forward, 6.5%, 5.5% type yield for a bond fund looks very good to us.
There are 2 points here. One is, does this look attractive now? And the second is, where is the next rate? Where does the move come from? Is it higher or is it lower? There are 2 different discussions, right, and how sticky this is going to be. How big is the argument right now in some of these meetings at PIMCO?
Well, I think you were talking about real yields, and I was nodding. When you look at real yields and look at long-term history, it's starting to look attractive. Here we had this period after 2008, quantitative easing and all of that, and depressed real yields. But you're now seeing real yields at attractive levels, and nominal yields I was quoting before look pretty good to us. You have, in the outlook, you have inflation still stubbornly high at the core level, improving much faster in the US compared with Europe. But I think the jury is still out there. But then don't forget the recession risk. We have had very significant global tightening across the world, and yes, the data has been better than expected, particularly in the US this year. But as we all know, these central bank tightening takes time to feed into the real economy. So looking forward, the jury's still out on inflation, but that recession risk remains significant.
Critical question for PIMCO, and it's not only the heritage of PIMCO from Bill and Mohammed forward to the great call you people made a number of years ago. You've got the advantage of the former vice chairman, Richard Clarida, I believe, darkens the door. I can just see Balls and Clarida in a debate over where we're going to reset on our start, and almost on a global R start. Do you sense within all the great work you do, Andrew, that we're going to reset in a new rate regime, something that we've never experienced before?
So I think it's an interesting debate. Rich and I tend to agree and on this point that as you look forward beyond this inflation episode, the cyclical rise in policy rates we've seen, there's good reasons to think that R-star neutral rates are at the low levels that we've seen for the last several years. We'll see this in the Fed's projections this week, but the chances are the Fed will also see 2.5% as their long dot. So compare the 4.5%, 4.3%, 4.4% for the 10-year Treasury, or look at the forward rates and compare it with that neutral anchor. We believe that anchor remains the correct way to do the analysis, and then the long-term outlook versus that then looks very attractive, I'd say.
Does Lagarde have an R star? Does Ueda have an R star? Dare I say, does Bailey have an R star?
They all have their they all have the variations on this. I think the Fed maybe is a bit happier to talk about it sometimes, but again, looking at bond yields now. Even in Japan, you are getting to levels in terms of the 10-year yield where it's starting to look more interesting. Control for volatility, return per unit of volatility.
I agree with that.
And really it becomes a little bit once we get beyond the YCC, once we get beyond the yield curve control. So if you think that you have that anchor, and we do, then look at your 5-year forward rates to isolate the long-term expectations beyond this central bank cycle. And that's the environment when it's much easier to come in and be positive like I am today compared with the lows of the COVID period.
We don't spend nearly enough time talking about this. How different this regime is to the regime of the last decade before the pandemic. How different is it for you and the team? What have you had to change just in terms of your approach away from zero rates and QE forever towards potentially the Bank of Japan hiking interest rates, the ECB going to levels I never thought they'd get to. I thought maybe they'd go back to 0, but here we are at 4%. How different is this for you and the team?
Well, I think it's very different, and I think as a bond manager, you like to see these high yields at the front end of the curve. It becomes really interesting, the relative value at the front end of the curve. You know, the 0 yields. Remember those. Something that hopefully we've consigned to history. I think one important thing looking forward, different to the last 10 years, is uncertainty around inflation. So we see inflation coming down towards central bank targets, a little bit above, but coming down over the course of next year. But I think clearly there's much more uncertainty in the inflation picture for the next few years compared with the last decade. And so back to the discussion before, you should be getting term premium. You should be getting paid appropriate term premium for holding the 10-year part of the curve. But again, comparing our forward rates with our expectations for our start, it looks like you're getting fair compensation after a period when, with quantitative easing and all, the risk premiums were really compressed.
What about in credit, though? I mean, given the fact that you're looking at greater vulnerability to an oil price shock or a unionization shock or a technological shock, some of these things that become that much more important when your cushion is that much smaller.
So I think the baseline for credit looks fine. I think credit should do well in an environment where you avoid the tails, not just about recession, but, you know, real recession, not just a technical recession. And on the upside case, if inflation is coming back into line with that fairly benign middle path, then credit should be fine. From our perspective, though, we want to guard against the tails. And if we do get deeper than expected economic downturn, you know, that's going to be painful in credit. So I think up in quality, IG looks attractive versus high yield. Avoid cuspier credits, avoid any kind of exposure to real default risk in what remains a really uncertain environment. It's not often you have these sorts of tightening cycles globally to such an extent. And then the final thing, there's lots of other stuff we can do in the world. US agency mortgages, very, very high quality instrument, very attractive in terms of the valuation. So again, if you can get to the kind of 5-6% type yields on core bonds, that looks pretty good to us in terms of the next few years.
Andrew, always a privilege. Thank you, sir. Andrew Balls there of PIMCO. Your bond market, 2-year just north of 5%, 10-year at the moment about 4.34. If you are just tuning in, welcome to the programme. Equity futures on the S&P positive by literally nothing, 0.04% higher. Outside of that, in the foreign exchange market, 106.68 on a euro, positive by 0.1%. Crude, new highs for the year in sight once again, 91.52 on WTI. Andrew Balls now needs to explain to Tom Keane who Norwich City is. TK, if we're going to do a football tour, you've got to talk to Andrew about Norwich.
Well, they're destined. Are they going to go up or down? I mean, I loved watching this weekend. Who played Chelsea?
Who did you watch?
Bournemouth, maybe.
Okay.
Brentwood, I can't remember. I love the little stadiums.
Brentford.
Yeah, there's no American equivalent to how close the people are, like in Norwich.
What's the Norwich Stadium like?
It's great. It's very loud. It's
the
old-fashioned stadiums.
The old-fashioned stadiums.
I go as often as I can without really annoying my wife. But I go to quite a few games.
But there's like here. There's like 10 Fenway Parks. Seriously.
Oh yeah. You know, I prefer the older stadiums as well.
It's very cool.
And then the new owners want to come and they want to rebuild things and.
So who are you playing in the
direction.
EFL? Norwich. See how I did that?
That's perfect.
Next one is Leicester, so top of the table clash coming up.
There we go.
Did I do okay there?
I'm proud of you, TK. Good stuff. Anne-Marie is in New York City for the UN General Assembly.
Leicester.
She's going to be joining us next from London. This is Bloomberg.
feel we made some good progress this weekend. I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down. I've never seen somebody win a shutdown, because when you shut down, you give all your power to the administration.
I can't believe there's another story that I follow less than this one. House Speaker Kevin McCarthy discussing the possibility of a government shutdown on Fox over the weekend. Bramo, so many people that listen to this programme find this subject absolutely tedious, and they start to ignore it. They ignore it, and then it starts to matter. Does this matter?
It seems unlikely that they're going to come up with some kind of proposal based on the fact that the proposals that they have out there aren't going to even pass measure within the own House. Here's the question. When do people start caring enough to possibly get on the same page and get to some agreement? When do people care enough to start putting that into economic projections, considering it does have something of a drag?
How linked is this mess with the impeachment inquiry that was started in the last week or so? Is that the bargaining between House GOP at the moment and the Speaker?
I honestly am not going to come up with rationale, but right now there is a bit of try to cater to the right of the party so that you can get some sort of deal through so that you're not accused of shutting down the government, and that probably is part of the wrangling in the House.
Equities right now on the S&P 500, just about positive to kick off things this Monday morning. Good morning to you all, up by 0.1%, let's call it. Yields just about unchanged on the session, came really close to intraday cycle highs on a 10-year a little bit earlier this morning. 435.45 was the high of the session, high of the cycle 436.18, and in foreign exchange, Tom, 106.69 on the euro, just a little bit stronger here. And if you're wondering where crude is, it's near the highs of the year, 91.40 on WTI.
Well, I'm going to go to $94. A 95 print would be shocking on Brent. We're not there yet, but that gets my attention. John, I'm just riveted with what we heard from Andrew Balls. I mean, I just think the three of us out at Norwich with Lester here on the 20th.
Well, I wasn't aware that Andrew's brother is no longer the chairman of Norwich City. He's since
Josh
taken on a
Sargent
different
hurt
role.
his ankle, the United States player playing for Norwich.
Nice.
And, you know, I think
watch him play Leicester.
They're strong. They start 4-1-1.
Okay.
It's a draw, not a tie.
Thanks for that.
Thank you. But it's good to see that from Norwich. Keeping up with Norwich football is Anne-Marie Horton in New York, our Bloomberg UNGA correspondent, and we welcome her to the worst traffic in the world. That would be Midtown Manhattan all this week. Your message, Anne-Marie, away from the follies of Washington is you're watching the meetings away from the green marble of the United Nations. What meetings really matter?
Well, the meetings that actually really matter this week are the meetings that are not happening at the UN General Assembly. So what we've learned over the weekend is that President Biden's National Security Advisor, Jake Sullivan, met with Wang Yi, of course, Xi Jinping's foreign minister, in Malta. And what those two were talking about, a number of issues, of course, but really the potential for Xi Jinping and President Biden to have a meeting. These two individuals, these leaders, have not met since the G20 in Bali. But obviously, we've seen a number of high-level meetings from counterpart to counterpart taking place in Beijing. This could potentially see Xi Jinping coming to San Francisco, to California for the APAC summit. That meeting took place, and then Wang Yi later this week is going to Moscow, where he'll sit with Sergei Lavrov, who will also be at the UN, but Putin will not be at the UN, Xi Jinping will not be at the UN, Mohammed bin Salman will not be at the United Nations. So I think I want to see what happens between that Wang Yi and Lavrov meeting, which is happening on the heels of Jake Sullivan's Malta trip.
Well, I want you to report right now, Anne-Marie, why is the UN suddenly a non-event? I mean, everybody used to parachute in. I have the memory of being at the Council on Foreign Relations, Lisa, and Muammar Gaddafi walking by me, granted with a security entourage of 14 people, but it used to be a big deal. Why is no one showing up now?
It's still a big deal. For Diplo nerds, this is amazing. You can walk down 3rd, 2nd, 1st Avenue and potentially run into, say, Erdogan. Like these moments have happened, and you get some of these moments where you can see also who they're speaking to, and it's the sideline meetings, of course, that happen alongside the UN. Like President Biden will be sitting down with Benjamin Netanyahu. Interesting enough that this is not even happening at the White House. It's a meeting, a bilat alongside the UN. Obviously, there's been some tensions between Jerusalem and Washington. I'm just saying, in the broader aspect of what is happening in the geopolitical landscape in the world right now, the most important meetings, when you look at Jake Sullivan and Wang Yi in Malta, then Wang Yi going over to Moscow, those meetings are happening outside of New York City.
Yeah. It's like, Lisa, when I talk to Pharaoh, it's so rare, it's like it's a bilat. when John and I talked
I immediately Googled Diplo nerds, and there's actually an entire website devoted to games called Diplo nerds. I am curious, though, Anne-Marie, this idea that the United Nations is losing relevance is something a lot of people have been talking about, which raises a question of where are the forums going to be held, in what kind of space to bring powers together at a time of increasing divergence. Is this something that people are really talking about at this UNGA meeting?
At every UNGA or UN General Assembly meeting, people will cast the fact that is the UN obsolete? And I think the past year and a half has showed just how constrained the UN. I mean, Russia sits on the Security Council of the United Nations. The most they can do is get the General Assembly to condemn Putin's invasion of Ukraine. But can the UN actually do anything to stop this war? No. And that's part of a lot of criticism that the UN gets. But really, it is just a forum to bring individuals together. Another interesting story that will be happening alongside the sidelines of the UN General Assembly, I reported this last week, and the Iranian Foreign Ministry confirmed it this morning. We will be having a prisoner exchange today between Iran and the United States. I've also have reporting that $6 billion of Iranian funds that were held frozen in South Korea have now been delivered as of this morning, about 4 a.m., 5 a.m. Eastern time this morning, have been delivered to Qatari banks. And what our colleague Arsalan is reporting is that potentially there will be some discussions on nuclear program in Iran between intermediaries with the United States and Iran alongside UNGA this week.
Just to follow up on what you were talking about earlier, this idea that one of the most important meetings already took place between Tony Blinken and his Chinese counterpart. Was there any resolution from that? Was this paving the way for some sort of Biden-Xi bilat or something further to really shore up relations?
This Jake Sullivan meeting, I think, really is the preview for the potential Xi Jinping-Biden meeting. These two individuals have that unfettered access to their principles, and they could speak a little bit more candidly than you would see, say, a Gina Raimondo and her and her Chinese counterpart, or Yellen and their counterpart. Jake Sullivan and Wang Yi are the ones that can really set the parameters of this meeting, which the United States has been asking for. And Xi Jinping at the moment is dealing with a difficult economy domestically and also difficult issues within his government. You know, we still have missing Qin Gang, the former Chinese ambassador to the United States, who was the foreign minister. He was the one that should have been sitting with Jake Sullivan, but he has disappeared, and unclear where that individual is right now. And then, of course, Li Shangfu, who U.S. officials believe was removed from his post. This was the head of the military, the defense minister, who they've refused to have a meeting with Lloyd Austin with because of the fact that he was sanctioned by the United States. So you see some movements within the Chinese government. You see concerns domestically with the Chinese economy. Potentially, this is the time Xi Jinping wants to come to the table, and it would be on U.S. soil.
MH, we've got to squeeze this in. How has the U.S. military seemingly lost an F-35 fighter jet?
I do not know. I do not have answers for this. I've been looking to see what the command center is saying. The pilot was able to evacuate, but still this F-35 seems to be missing. I have a lot of questions, as you do.
Amazing story. Amazing story. Anne-Marie, over in New York all week for us for the UN General Assembly, or locally known as UNGA.
I hate it.
I feel sick saying it.
UNGA. Actually, it's really fun to say it repeatedly.
No, I'll take a pass.
UNGA. Hooked on a feeling.
Wow. What was that?
It wasn't B.J. Thomas. It was after that. Somebody did a redo of Hooked on a Feeling, and they go, UNGA.
So that's actually a song?
Yeah. It was a big hit. Huge hit for B.J. Thomas.
It's a break, Grandma. I don't know how you feel about that.
I think that it would be really great. I think it would be good. Let's do it.
How'd you lose an F-35?
I don't know. I mean, here's my question. What do they know that they're not saying?
There's always something.
Right. So is this an issue of the weather needs to clear to then go into the lakes or wherever that they think that there could have been some sort of accident? Was this something about the transmission system and what could have gotten hooked in? I don't know.
So was it on autopilot still with fuel?
I don't know the details.
Oh, okay.
I don't understand. We don't even know why he ejected the pilot.
Pretty fascinating story.
It is.
Isn't it? Catherine Neese of PGIM Fixed Income is coming up shortly as we kick off the trading week full of central bank decisions. Equity futures totally unchanged on the S&P 500. Live from London, this is Bloomberg. Coming off the back of a very mild week of losses on the S&P 500, trying to bounce back, but no sign of a bounce currently. Unchanged on the S&P 500. Likewise on the Nasdaq 100, down by about 0.06%. No drama this morning. The week really begins on Wednesday. We'll talk a lot about those central bank decisions throughout this morning and, of course, through the week. In the bond market, 2-year, 10-year, 30-year, just to slice up the yield curve as we often do across those three maturities. Your 10-year yield came very, very close to a cycle high a little bit earlier this morning, within a basis point of it. This morning, we're now just about unchanged at 433.85, but still here, Lisa, in the 440s on a 30-year. Still there.
We were supposed to be down to 3.5%, according to some. We were supposed to be already talking about recession in the U.S. Instead, we're talking about the ongoing potential for a wage spiral. We're talking about ongoing upgrades to economic growth. And we're talking about a 10-year Treasury yield that is closest to the highest levels back to 2007, raising real questions what the Fed is going to do on Wednesday in terms of projections.
Climbing for 3 consecutive sessions. Just building on some of the moves we've seen recently going into the Fed on Wednesday. Lisa, I want to finish on foreign exchange. Just get to the euro quickly. It's been 9 weeks of dollar strength against the weaker euro. And those numbers just tell the story, don't they, Bramo? 106.66 for the ECB.
Is this driven by U.S. strength or European weakness or both? And so how do you get the dollar really dictating what we hear, not just from the Bank of England and the Bank of Japan this week, but also the Bank of Sweden and Turkey and everyone else who's going to be reporting?
I think we really focus correctly on bonds, but I really want to state here something we haven't stated. The resiliency of the equity markets is shocking. If you gave me the news flow, including U.S. government shutdown right now, I suggest we'd pop down 8%, even 12% on equity markets as a guesstimate, and it hasn't happened.
So question of the moment. I'm going to go back to it, and forgive me if you've heard this a million times because I'm on repeat on this point at the moment. Reflection of the extension of the cycle or a recipe to end it? Crude in the 90s, bond yields back to 430 something, 2-year at 5. Which one is it?
It depends on what's driving it, especially with crude, given the fact that if you look at it on an inflation-adjusted basis, it doesn't look so bad relative to recent history. In the U.S., when it comes to rates, is that being driven by healthy inflation or unhealthy inflation on the heels of some of those crude moves?
Top stories this morning. Under surveillance, the Fed set to make its next rate decision on Wednesday. Investors betting the FOMC will hold rates at a 22-year high. Meanwhile, in the labour market, they've got to talk about this. The UAW rejecting a 21% pay raise from Stellantis. Negotiations between the UAW and automakers will resume today. If 20% doesn't get it done, I spoke to David Welch about this about 2 weeks ago, going into the deadline, and I said, what do you think gets it done? That's our Detroit reporter, incredibly well connected. He thought 20% around that kind of level would get it done. 21% isn't getting it done.
So what does it have to be, and what does it do to the Detroit auto manufacturers at a time of incredible competition? Or even
Who says it's just
Europeans?
about the pay? It's about the other themes as well.
Totally agree.
32-hour
Yeah,
work
sure.
week.
It's super nuanced.
And the whole EV dynamic is interesting me more and more. They want union electric vehicle jobs. And Mari Barr is basically saying no, right?
Well, Tesla's rubbing its hands together, Tom, because they don't have to face that problem. Europe is facing the consequences of underinvesting in the continent for a long, long time and being behind this race. Behind, and Lisa, ultimately it means perhaps competing with Chinese manufacturers that do this at a much, much lower cost. And as we mentioned in the previous hour, Jeff Yu of BNY Mellon said it, something changed in Europe over the last couple of weeks just on this front. It feels like the EU aren't going to tolerate that competition. They won't allow it.
Because they understand how much ahead China is when it comes to that. But from a worker's perspective, how much are they getting in to try to affect how some of these technological changes affect their jobs before it's too late?
Let's turn to this story. Speaker of the House, Kevin McCarthy, outlining demands to avoid a government shutdown. McCarthy calling for an 8% spending cut to domestic agencies and for work to resume on a border wall. The House expecting to vote on the measure on Thursday. Tom, we're doing this all over again.
We're doing it over again. I love what the Washington Post had this morning, where there's 5 ideological cohorts of the Republican Party. My basic idea is even the least sophisticated people know an 8% budget cut, either, I assume, nominal, maybe they even mean real. It's just foolishness. It's like, why waste our time of all political persuasions doing that?
This is not popular with voters. Let's just put that. Nobody really likes seeing government shutdowns. How divorced is Washington getting, frankly, from voters, whether it's on the Republican side with government shutdowns or whether it's on the Democratic side in terms of Biden and the viability of his candidacy. And it raises this question, at what point will political dismay at a potential government shutdown actually mean anything in D.C.?
Let's finish on the commodity market. We've talked lots about the economic perspective of this, but let's talk about the politics of oil pushing closer to $95 a barrel after a 3-week rally. The surge boosted by higher demand and continued supply cuts from Saudi Arabia and Russia. The Saudi energy minister, as Lisa has pointed out all morning, is set to speak a little bit later on today at 10 a.m. Eastern Time. Energy costs putting pressure on businesses, consumers, central banks, and arguably maybe even putting pressure on this White House. TK going into an